declines hovering around in the 4, 5, 6% range. Those have doubled right now. So we're seeing about 12% declines in the video subscriber base. So obviously it does not bode well at all for the linear networks, the linear network business. And I think Bob Iger was exactly referring to that. Having said that, though, I think he's making a little bit of a differentiation between, the ESPN assets, which are still very, very valuable to Disney. So they're obviously trying to find some kind of future path with, that bigger foray into the direct-to-consumer portion of the ESPN business. But they are also saying that all the rest of the networks, so whether it's a Freeform, whether it's a Disney Channel, whether it's an FX or a National Geographic, those are, or even the ABC broadcast network, all of those are non-core assets, and they're really looking to kind of offload those assets. So it's going to be interesting. I mean, obviously the writing is on the wall. These assets are in structural decline. The question is, yes, it's a good thing if Disney can actually get rid of those and get some cash back into the business. The question is, who's really going to buy that? I mean, is it going to be private equity? Is it going to be another media company? There's just no healthy future outlook for those assets. So I think that is really the biggest question right now in investors' minds.
And Disney also extended Bob Iger's contract by another 2 years to 2026. Shocking, right, Paul? I know how closely Paul watches the stock Mickey Mouse, but what does it mean when it comes to giving a longtime executive like this more time to implement his turnaround plan and to ultimately find a successor?
Yeah, I think that there's the positives and the negatives. The positives, obviously, it signals a lot of stability for the company, especially when we have such a turbulent kind of a media ecosystem right now. So obviously Bob Iger knows what to do. He's not going to be shy about doing it. And remember, we already have some kind of management upheaval with the departure of the CFO, Christine McCarthy. Yep. So kind of not having Bob Iger there would have led to kind of 2 executive searches at the same time, which would have been a little bit difficult, I think, for the company to maneuver. So I think this kind of makes sense. But again, it brings again to light the biggest issue for Disney, which has been the succession issue, and that just continues to be an issue. So again, there's a little bit of good and bad, but I think as we kind of navigate this very, very tumultuous time, it's good to have kind of a steady hand with Bob Iger.
And I hear from a little birdie that Walt Disney Company is going to have an investor meeting, a good old-fashioned, bring everybody down to Disney World or Disneyland in October. And Geetha, I'm sure, will be there reporting back to us. But that's where I'm sure they'd like to make some big announcements, so be on the lookout for that. Geetha Ranganathan, thanks so much for joining us. Geetha is our global head of all media in research, and we appreciate getting a few minutes of her time. But again, as Geetha was just suggesting, it's a tough time to be an investor in the media space. There's just so much uncertainty there.
And looking at Disney's stock, ticker symbol DIS, it's flat for the year. You look over the past 5 years, down more than 20% in that span.
Yep, exactly. So, as these companies pivot from the traditional distribution of cable systems and satellite systems to this new thing called streaming, there's just a ton of uncertainty about how that will happen and the actual profitability of that business. Right now, let's head down to Washington, D.C. We'll get world and national news with Nathan Hager.
Okay, Paul, thank you. Treasury Secretary Janet Yellen is keeping her forecast for a soft landing in the U.S. even after the latest weak economic data out of China. In an exclusive interview you heard on Bloomberg Radio and saw on Bloomberg Television, Secretary Yellen said China's slowdown could spill over to the global economy, but the U.S. is holding up.
Growth is slowed, but our labor market continues to be quite strong. I don't expect a recession.
Secretary Yellen spoke with us from the sidelines of the Group of 20 Finance Ministers Summit in India. Russia has pulled the plug on the deal that has allowed Ukraine to ship grain out of the Black Sea for nearly a year of war. Bloomberg's Rosalind Matheson reports this shouldn't come as too big a surprise.
This grain deal has largely been dead anyway for some weeks. There's been very little movement of Ukrainian grain out past Turkey into the rest of the world anyway. So it's been really troubled for some time.
Bloomberg's Roz Matheson. This follows another attack on the main Russian bridge to Crimea. 2 people were killed. A teenage girl was hurt in the explosions. Russia blames 2 Ukrainian drones. Ukraine hasn't said anything about it. Just 7 weeks into his presidential campaign, Florida Governor Ron DeSantis is hitting reset, firing some staff, paring his travel schedule down to the early voting states after burning through cash. AGF Chief U.S. Policy Strategist Greg Valliere says it is not looking good for the governor.
He has been in free fall. His campaign has not gone well. He had to lay off several campaign workers over the weekend, and his fundraising was mediocre.
AGF's Greg Valliere tells Bloomberg Daybreak fundraising for all the candidates was underwhelming. DeSantis' pivot continues tomorrow. He gives his first interview to a non-conservative outlet, CNN. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. The S&P 500 continues to add to last week's gains. We're now a little less than 6% away from the all-time high that we set at the start of last year. David Balin at Citigroup Private Bank says this market continues to prove the bears wrong.
Well, it's a bull market, I think, born of a variety of things. Number one, a lot of exceeding expectations. You know, we had started the year expecting that there'd be an energy crisis in Europe. That didn't happen. The banking crisis, you know, that you've discussed this morning didn't turn out to be a banking crisis. Growth turned out to be better than expected.
Well, the S&P 500 right now 5 points higher, up 0.1% at 4511. Dow Jones Industrial Average up 34 points, and the Nasdaq 100 up 51 points. That's up 0.3%. Among some of the individual companies, Eli Lilly says it's applied for full U.S. approval of its Alzheimer's disease drug. Then you have Paramount Global shares. They're declining after Mission Impossible Dead Reckoning Part 1, the seventh installment of the action franchise with Tom Cruise. That took in less than projected at the box office. You know you've been waiting for this. Krispy Kreme partnering with M&M's among the offerings. A chocolate candy surprise donut filled with M&M's.
How did that not happen before yet? Yes.
I think you get a gift certificate to go see your cardiologist after eating that. Anyway, no, I'm making that up. That is your Bloomberg Business Flash. I'm John Tucker. Paul and Jess.
Thank you, JT. We appreciate it. That's definitely something that I feel like I'm going to have to try. I love M&M's. Donuts, best of both worlds. So I want to switch things up for our next guest, Paul, do more of a macro take since we are in a blackout week here with central bankers ahead of the Federal Reserve's decision next week. I want to bring in Hugh Roberts, head of analytics at Quant Insights, who's joining us on Zoom to discuss investing in everything when we're thinking about AI to commodities and what his models are signaling about the outlook for a potential U.S. recession. Thanks so much for joining us today, Hugh. What's your view, taking kind of a step back here before we get into some of the other things you're looking at as far as where the U.S. stock market is headed in the second half of the year?
Well, as things stand, macro momentum continues to trend higher on our models. Looking at the S&P, looking at NASDAQ, looking at Russell, there's a trend improvement in macro conditions that's been in place for several months now. So what we mean by that is we aggregate measures of economic fundamentals, growth, inflation, measures of financial conditions. Think about your Bloomberg FCI, for example, real yield, slope of the yield curve, FX strength, and then measures of risk appetite. And we use an algorithm, an AI-driven process to look at the independent pattern between all these macro factors and a single financial asset. And at the moment, they're all trending. It's a grind, but it's pointing north for all the major U.S. equity indices.
So, I mean, one of the concerns, Hugh, from a lot of investors, maybe more fundamental investors, is there's just not a lot of breadth in this market. It's a handful of names pushing this market up. If you're not in those names, and you look at the equal weighted index for the S&P, for example, you're really, you know, the performance isn't nearly as good. How do you guys think about that, quantify that?
Yeah, no, I think that's a very fair observation. So the way we think about that is we build a model for example, the equal weighted ETF relative to the market cap weighted one. And we've done that for the S&P. We've also done it for NASDAQ in terms of QQQ versus the QQEW. They both show the same story, that agree totally that the Magnificent Seven are rich on pretty much every metric, standalone basis, what they've done to the equal weighted indices vis-a-vis the market cap weighted. But at the moment, the trend is still with them. So it's kind of a momentum play at the moment. So I understand the fears totally. But we, from our side, our models are not showing any signs yet of a break in the primary trend.
I was actually looking at some Bloomberg intelligence data from Gina Martin Adams, Paul. Obviously, your people over there, and it was interesting to me when they were looking at, to your point, when you're looking at about what happens with this narrow breadth. So the top 20% of stocks by market cap carry a median close to 20 times forward earnings, and then when you compare that with just 15 times for the smallest 100 stocks, Hugh, I'm wondering, as far as when you're looking from a valuation perspective, how much necessarily needs to be rectified, and could we continue to see more of a movement here, especially if, say, earnings come in a lot better than expected for these mega cap names? Could things still get even more pricey from here?
Yeah, I think that's exactly the right way to look at it. I think, we're macro biased. We think that ultimately macro fundamentals dictate pretty much the price of everything, whether single stock, index, bonds, FX. But clearly in the middle of earnings season, IDEO becomes top step for a couple of weeks. And I think you're right. The Q2 earnings season is going to be absolutely vital, probably in determining whether that trend can continue. I mean, the numbers from, for example, NVIDIA last time were just such a game changer, blowout event. Has the bar been raised that makes it higher for them to beat this time around? Look at Tesla coming out tomorrow, on Wednesday, I beg your pardon. We all know that they had blowout delivery numbers in Q2, but that came at the expense of their incredibly, for the sector, incredibly strong margins. So I think there are some genuine questions that the kind of bottom-up stock pickers can answer. All I can tell you is from a macro perspective is back to that first point, that the mix of growth, inflation, financial conditions, risk appetite at the moment continue to be supportive. The downside is that most of these things, and especially the mega cap Magnificent Seven, have all moved ahead of our model value. So they all screen as rich. So they've discounted a lot of the good news already, which I guess from your question's perspective, yeah, the risk reward might now be a bit skewed.
Hey, Hugh, when I started on Wall Street in the mid-'80s, Japan was all the rage. It was the growth story. If you wanted to further your career on Wall Street, you had to do a stint working in Tokyo. But really for the last 15 years, not so much. Now I've got Warren Buffett going over there. He's adding to his holdings. Do we need to revisit Japan?
Yeah, I think that's very fair. I mean, clearly there is the Buffett effect, not least the investments, but the fact that he flew over there, and then the way he's obviously funded his exposure as well, using the rate side of the trade as well. And interestingly, I think the way we're looking at it, given that earlier point about macro momentum still seems to be positive, and if you could have subscribed to the cliche about equities climbing a wall of worry, I guess what most investors are really thinking about now are, right, where are the cheap laggards that I should be screening for now to play catch up, and where are the things that have run ahead of things? Now, clearly the Magnificent Seven fall into the latter camp. In terms of the laggards, although Japan's had a lot of good press, when we look at something like JPXN, one of the popular ETFs for gaining exposure to Japanese equity markets, and we look at the relative value versus the SPY, it's actually lagged quite substantially. Not on our models, it's nearly 5% cheap. So this is one occasion where the hype in mainstream media hasn't actually translated through to price action. So I agree totally. Japan has got an interesting story around it, and on our metrics has got a useful, an efficient entry level as well.
Hugh, I know you also keep a close eye on commodities. What do you think the direction of oil prices is telling us about the global economy right now?
So right now, our oil model is undergoing a bit of a regime change. It doesn't have a strong explanatory power. One of the things that our process spits out is a model confidence. It's just an R-squared stat, goodness of fit. So how good a job are these macro variables doing at explaining price action? And right here, right now, oil's model confidence has dipped a little bit. So we don't have a strong call on it at the moment. I guess like a lot of people, though, given the big week we had for the dollar last week, we're really, really watching that, because obviously all else equal, you would expect if the weaker dollar story gains more legs, and I think that's a big if personally, but if it does, then you're going to see investors turn their spotlight onto emerging markets, onto commodities, and you could start to see that pick up. But I guess the main thing really for oil people, we know the supply argument, it's now the demand side, and for that, yet again, I'm afraid it's back to talking about Beijing, and when we start to see some details of the stimulus that they've promised us, but which so far has been lacking.
All right, Hugh, thanks so much for joining us. Always appreciate checking in with you. Hugh Roberts, Head of Analytics at Quant Insights here, looking at these markets here. Again, big earnings coming up over the next several weeks. We've got the Fed announcement at the end of this month, so a lot for this market to digest.
There definitely is. And we do get housing data this week as well, so that'll be there, as well as home builders are reporting earnings like D.R. Horton, so another read on the economy.
Yeah, absolutely. Looking at this market right here, up about 0.2% on the S&P. NASDAQ doing a little bit better, up about 0.5%. We're going to have more coming up. This is Bloomberg. Let's check in company news now with Steve Rappaport.
Good morning, Paul. Shares of United Airlines are up more than 1% after the carrier and its pilots came to terms on a new contract. Bloomberg's Jeff Bellinger reports.
Steve, it took more than 4 years of negotiations to craft a new labor agreement that is the richest ever for a U.S. carrier. The Airline Pilots Association says the deal, valued at about $10 billion, provides a cumulative pay raise of as much as 40.2%. The agreement also contains improvements to areas such as job security, retirement, and benefits. The new 4-year deal will help ease pressure on United, which has recently come under criticism after a series of delays and cancellations, even as the airline experiences soaring demand. Steve?
Thanks, Jeff. Ford is dropping prices on the electric vehicle line of its F-150 pickup truck. Bloomberg's Katie Greifeld has more.
Prices for all versions set to drop by at least $6,000. The biggest price cut on the Pro model comes in at nearly $10,000. Now, for the Y, they said that this really comes back to improving costs and also increased plant capacity. For example, if you look at their plant in Michigan, it's been closed to complete upgrades that should triple its annual run rate to 150,000 Lightning trucks.
Thanks, Katie. Ford shares currently down more than 4%. And Microsoft strikes a deal with Sony to ensure Activision's Blizzard's Call of Duty franchise remains on the PlayStation platform for a decade. The agreement is part of Microsoft and Activision's efforts to appease regulators as they move closer to a $69 billion merger. Those are the company stories we're following this hour. I'm Steve Rappaport, and this is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, taking a look at these markets here. Pretty steady move upward, but up about 0.2% on the S&P 500, about 0.5% on NASDAQ. Yields pull in just slightly. Got the 10-year trading at 3.82%, so pretty calm there. WTI crude oil off just about 0.5%, sitting right at $75 per barrel, and Bitcoin, it is pretty much unched on the day at 30,280. So there you go on some of your stats out there. Let's head down to Washington, D.C. right now. We get world and national news with Nathan Hager.
We're talking about the weather, Paul. The Northeast is starting to dry out from 2 rounds of heavy rain in a week. That includes a flash flood in Pennsylvania that claimed at least 5 lives. Tim Brewer is the fire chief in Upper Makefield Township in Bucks County, PA. He says the search will continue for 2 little kids who are still missing.
We have deployed a massive amount of resources and teams. We have basically tripled the number of assets in the area
to find a 2-year-old girl and her 9-month-old brother. Flash floods also hit parts of New York, New Jersey, and New England over the weekend. Worldwide, this year is on track to be the hottest on record. We get more on that from Bloomberg's Amy Morris in Washington.
Simultaneous heat waves are stifling the U.S., much of Europe, and parts of Asia. El Nino is intensifying in the Pacific, while the Atlantic waters near Florida topped an unheard of 90 degrees. NOAA says 22 of the past 23 years were the hottest ever. Right now, 2023, 2020, and 2016 are all vying for the record. Climate scientists warn that the only way to stop this trend is for people to immediately and dramatically reduce their use of fossil fuels. In Washington, I'm Amy Morris, Bloomberg Radio.
On top of all that, though, Canadian wildfire smoke is back in parts of the Northeast and Midwest. The air quality in New York City is set to be unhealthful for sensitive groups across the city later today. It's already there in western New York and in parts of Chicago. Right now, there are nearly 900 fires burning across Canada. 580 of them are out of control. Kevin Spacey just got some help in his sexual assault trial from Elton John. The pop legend testified by a video link from Monaco to the London court where Spacey's facing sexual assault charges from 4 men. John said the actor did not attend the annual party at his home where one of Spacey's accusers says he was attacked in 2004 or 2005. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington, and this is Bloomberg. Paul and Jess.
All right, Nathan Hager, thank you so much. We appreciate it. Jess Ment and Paul Sweeney here in our Bloomberg Interactive Broker Studio. You know, Jess, I've been asking, a lot of strategists when they come in here, what's the earnings risk in the marketplace today? But there's an intrepid reporter out there with a story that says actually taking some numbers up.
Right. I did a story over the weekend for our Earnings Watch column where I was actually compiling data from your buddies, Gina Martin Adams and her team at Bloomberg Intelligence. So I was speaking with Michael Casper, who's an equity strategist at BI. So even though this is supposed to be the 3rd consecutive quarter where we'd see a contraction in earnings growth year over year of about 9%, when you look underneath the hood, they actually have this earnings revision momentum indicator that's important because if you look at the net revision momentum over the next 12 months for EPS, it's actually being marked up more. And when you look at the point of it is that it's well off the trough back in November. So that's signaling when you're looking at companies that are getting more marked up, particularly those that are positive, it's industrials and discretionary. And those were the 2 industry groups that led the earnings growth decline last year, very cyclically oriented in what it tells you about the health of the economy. And then also information technology is getting close to be turning positive. So this really tells you, if you're looking at the outlook for earnings growth, much more positive. And then also, if you look at the S&P 500 and you exclude energy, that was actually masking a lot of the pain in the broader index last year. And the opposite is true this time around, where the weakness in energy is sort of masking the strength in some of these other groups. So this is telling you actually the earnings recession started in the 2nd quarter of last year, and it hasn't necessarily been just 3 quarters. So that could bring more brighter times ahead and how that correlates to the stock market.
And that's consistent with what Gina Martin Adams and her team have been saying, that, when we saw the bottom in the market last, October, November.
Right.
That was it.
Yeah.
And she was consistent on that call. Even when people were talking for a double dip and things like that, she said, no, the market priced in all the higher rates pretty much right around then. And she's been right. We're going to have more coming up. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Metton and Paul Sweeney here in the Bloomberg Interactive Brokers studio in New York City. We are streaming this thing live on YouTube. Just head over to YouTube. I think that's the intro web. And search Bloomberg Global News and you'll find us there. How about that? Coming up in this hour, we're going to check in with Billy Lipschultz. He covers the markets for us, get the latest on what's happening out there in the market. Plus, RJ Gallo, he's a senior portfolio manager with Federated Hermes. He's going to join us and kind of give us his market call as we really get into the teeth of the earnings. And then Anna Wong, chief U.S. economist with Bloomberg Economics. She joins, and when she comes in, I'd write down everything she says because she and her team have been just killing it with the calls over the last couple of years. So we'll get her thoughts on where this economy is heading. But right now, let's go to John Tucker and get a Bloomberg Business Flash.
All right, thanks, Paul and Jess. S&P 500 higher, adding to last week's surge. 5 of the 11 major industry groups in the index, they are higher right now. And ahead of earnings, the financials, the best performing industry group. Biggest drag that's right now coming from utilities. For the year, the S&P 500 is up close to 18%. Michael Schul at Market Field Asset Management thinks the rally in stocks is going to start to broaden out.
You know, I think people have been too negative all year about U.S. economic growth. I think they talked themselves into looking for a recession. I think as a result, a lot of the cyclical sectors haven't been terrible, but they haven't participated in this rally at all.
Right now, the S&P 500 7 points higher. That's up 0.2%. We're at 45.13 on the index. The Dow Jones Industrial Average up 56 points. That's up 0.2%. NASDAQ 100 51 points higher. That's a rise of 0.3%. Treasury Secretary Janet Yellen telling Bloomberg China's economic slowdown risks causing ripple effects across the global economy, though she does not expect a recession here in the United States. Well, you know, it took a while, but Tesla has built its first cyber truck. Comes 4 years after Elon Musk unveiled the prototype. Big reason for the delay, the body is made out of stainless steel.
What?
Isn't
that heavy? Hard to make?
I don't know if it's heavy, but it's hard to, like, bend and weld and all that stuff. Now, didn't, what was the vehicle that, what's his name? The DeLorean, was that?
Oh,
that
yeah.
was stainless steel,
I think it
wasn't
might have been. Yeah, made a good movie about
So
that.
you have to use the polish on the car that you use for the hood of your oven.
You made a time machine out of a DeLorean?
Back to the Future.
Look at you getting that cultural reference. Bailey, not so much.
Not know Back to the Future.
Oh,
She wasn't even born yet.
Behind the glass, these guys get nothing of what we say.
I was definitely alive when, not the first one.
Tony
that came out,
Dan's,
but come on,
you were
look at this
talking about
today.
before, and
Just keep shocking y'all left
Back
and
to the
right with all of these.
You're good.
See,
She is.
I'm
All right.
aware.
John Tucker, thanks so much. We appreciate it. Let's get a sense of what's happening with these markets here. Billy Lipschultz back in the Bloomberg Interactive Broker studio here. Billy, what are you looking at today?
I just want to start off saying I was Marty McFly for Halloween a couple years ago.
Thank
so
you.
I got the
love
reference.
that.
I swear I got the reference. But we are seeing a market that still is kind of in a bit of a holding pattern after that China economic data. Obviously, earnings season is upon us. We have a busy week packed coming ahead in that Fed quiet period. Looking at some of the outperformers in the S&P 500, big driver today is Apple. Even though it's only up 1%, it's responsible for 4 points to the upside. The laggards that are not that big, but laggards are Verizon, Disney. Some that are weighing are Amazon and Meta. But looking a bit under the hood, I know I love talking about biotech, talking about the small stocks. These are not small stocks, though. Argenx, ticker ARGX, up 31%. This is a company that's $28 billion in market cap. So one of the 11 biggest companies in the NASDAQ Biotech Index, leading to the upside, providing a bit of a boost. Another stock on my radar is Bridge Bio. They had positive data for their heart drug. Stock's up 62%. So again, that's a company that still is closer to $5 billion, and that strength of that study is actually showing up in a company called Alnylam, a competitor, ticker ALNY, up more than 8%. That's almost a $27 billion stock. So we are seeing big moves from bigger biotechs as opposed to, jumping on talking about $100, $200 million market cap doubling. We're seeing big rallies for a lot of good, strong readouts today, and I think that's really showing up in the market. Again, S&P relatively flat. You look at the NASDAQ biotech up more than 1.5%, XBI, which is equal weighted up, double that essentially. So strong day in biotech if you're looking for some areas that are outperforming.
Whenever I look at the biotech group in the S&P 500, it's actually down a little bit more than 10% this year. I was kind of curious whenever you're speaking with your sources, whether it's biotechnology or maybe other riskier corners of the market, because you also cover not just this, but when it comes to the meme stocks too, and what that means. What are you seeing there, and are you seeing any of the FOMO begin to trickle back into some of those names?
Well, I think when you look at biotech's its own beast. So if you look at the S&P 500 biotech components on a year-to-date basis, Moderna down more than 30%, Incyte, which is a big player, down more than 20%, AbbVie down 16%, Amgen down 13%. So these are big biotech names that your typical generalist portfolio manager is aware of and is investing in. And so you're seeing really what's been a choppy tape across big biotech over the last 2-3 years after that big rush in 2020 and 2021, where investors wanted to pile into those COVID beneficiaries. But broadly speaking, Jess, when you look at the meme stocks, you look at the ARC components, the highly shorted stocks, the non-profitable technology companies, we did see a big rush towards them last week. We saw profitless tech up double digits on the week. We saw meme stocks having their best week since late January, So it does seem like animal spirits are a bit alive and well. I mean, if you look at it just today, you're getting a bit too micro, but looking at the uptrend that we've seen, the swing higher so far this year, it does seem like investors want to take on risk, and that's also why you're seeing the likes of crypto-exposed stocks outperforming.
What about the flows data? If you're looking at Vonda Track, and there's a lot of different ways that you particularly gauge it, what is some of that data telling us when it looks like when you're trying to follow the money for retail investors in particular?
Well, you're still seeing them. They love SPY. They love the Qs. They love Tesla.
Right.
So still buying their favorite stocks. Overall flows are strong, but we are entering a time where seasonality really does reign supreme. Retail traders in the summertime like to go down to the Jersey Shore or the California shore.
With Paul.
They like to go on vacation. Paul's familiar with it. When
He sees them.
Just don't come to my beach.
But if you're on a beach, who's trading on Robinhood? So it really... It does. We are seeing a bit of seasonality with that, but I will say, looking at some of the Vonda data, that CPI print did actually draw more retail money than I think most people were expecting last week.
One thing I was curious about, especially when you have companies like Netflix, Tesla reporting this week, and you're tracking some of the flows data, what do you think this could potentially tell us? I guess when you've looked at in the past, whenever these companies have reported, and if they've greatly beat expectations or if they've missed, can that kind of be a contrarian indicator when you're looking at what is retail doing versus what, say, institutions and obviously hedge funds are doing?
Well, the big thing is retail traders like catalysts. So earnings obviously is the catalyst. So when you look at a Netflix or you look at some of these big companies, if they miss and there's a sharp sell-off, retail loves nothing more than buying the dip, but they also love chasing rallies.
Right.
So it's kind of a circumstance where if you have a big beat, obviously you look at NVIDIA last quarter, that drew in everyone's money, but retail was more than happy to chase that. And on the flip side, we've seen plenty of times where earnings will come in sharply lower. We'll see a 5 or 6% sell-off, but retail's putting the money betting that the market will eventually go up and they'll be buying the dip and that'll pay off. We saw that happen even with those Amazon rumors about telecom stocks. We saw a lot of dip buying in T-Mobile and some of those other peers. Retail likes to gamble, but broadly speaking, they're just individual investors who have money on the sideline that they want to deploy. And when they see a stock down 5, 6, 7%, to them, that's a buying opportunity.
All right. That's a buying opportunity for a lot of traders, but that's a tough way to make a living. But a lot of folks feels like that's what's happening in the marketplace here. People are buying the dips. Billy Lipschultz, thanks so much for joining us here. I always appreciate getting your thoughts on these markets. Again, a little bit of green on the screen. Heck of a first half of the year for the equity markets. Kind of helps you forget a little bit what happened in 2022. But the question now is for a lot of people is, all right, now what do we do? And for that kind of question, we go to RJ Gallo. He's Federated Hermes. They got a couple shekels under management. They know what they're talking about there. RJ, you talk to your clients. I'm guessing most of them are pretty happy with the first half of this year. What do you tell them about the second half?
Well, good morning. It's interesting. I think that my equity colleagues, Phil Orlando, Steve Auth, somewhat constructive on parts of the equity market. I think, generally speaking, the rates environment and the inflation environment remain the dominant factors, but the introduction of the AI excitement clearly did motivate some significant stock moves earlier, in the last couple of months. On the rate side, we're still pretty defensive with respect to credit quality. We're still in the camp that the economy is going to slow. It already is slowing. Inflation is starting to cooperate more so, which is great, but the Fed is not done with the inflation fight. And the cumulative impact of the Fed tightenings very likely to still tip us over into a mild recession as we click forward over the next 3 to maybe 9 months. And as a result, we're still up in quality and a little bit long duration on the fixed income side.
So, especially when it comes to fixed income, what do you think the bond market is telling us ahead of the Fed's decision next week?
Well, the last week was a pretty telling week. Pretty good rally as the CPI posted pretty modest month-over-month increases, both core and headline. You also had the headline number fall to a 3.0%. Massive improvement from where we once were. Recall that the headline CPI once had a year-over-year rate of 9.1.
Yep.
At one point, people were sort of deriding the idea that we could get a disinflation with the phrase immaculate disinflation. In other words, you needed to have a deep recession to wring out that inflation. Well, so far, you've got over 6 percentage points of headline CPI improvement, less so on the core, but still improvement without a recession. So far, it's been pretty encouraging. I think the fact that so much progress has been made has led the market to price in maybe one more hike. I would argue that we at Federated Hermes have felt that the Fed was close to being done a number of months ago, that maybe 1 to 3 more hikes would occur. That's ultimately what's going to happen. That has underpinned our more optimistic view on duration, taking some duration risk in your portfolio. Typically, by the time the Fed stops its rate hike, the economy has slowed. Inflation, as we know, is cooperating. History suggests that the cumulative impact of the Fed's tightening is going to become the next driving theme, and that would be slower growth. Recently, the soft landing dynamic, soft landing narrative is probably a better phrase, has resurged. We would fade that on the fixed income side. We're still up in quality and long duration because we don't think soft landing is the base case.
So, RJ, that kind of brings me where I want to go. I have a hunch that if I were an analyst, a credit analyst on your team, I'd be knocking on your door saying, hey, I want to go and take some more risk here. I've run my recession models, my recession scenarios. I've cut my revenue growth in half or whatever, and we're still good. What are you going to say to me when I come into your office with that pitch?
Well, our investment process has both top-down and bottom-up elements. The top-down elements focus on the big picture drivers of fixed income performance, so duration, changes in the slope and shape of the yield curve, broader sector-wide changes in relative value, high yield spreads, corporate spreads, and for international portfolios, we look at currency as well. The bottom-up component is exactly what you just talked about. The analysts who specialize within the corporate areas, within the international group, within the muni group as well, on individual industries, if you will. And there are some mixed signals going on. The profit outlook is clearly deteriorated. More recently, there's some expectations it's improving. Obviously, the banks last week were pretty strong. We want to see how the sort of second tier, the regional banks, so to speak, how they fare before we start opining from a top-down standpoint that the risks to growth have passed and that the soft landing is here. The bottom-up component has a lot to do with the individual security selection, but we still are shaping our top-down components, duration, credit exposure, curve. We expect a steepening curve, by the way, because we think that that this expansion is long in the tooth, and the Fed's next moves will be eases over the next, say, 12 to 24 months, and the curve's going to start pricing that in. We still need our analysts to work on the bottom-up side, picking the right individual names, and we're very much focused on that, but we're not overruling our top-down views based upon some more constructive parts of different sectors and industries.
When you're speaking with your clients, what are some of their top questions and concerns at this time?
Top questions? Well, to be frank, last year, 2022, record bond bear market. And to toot our horn a little bit, we were well positioned for it. We were short duration. We anticipated a flatter curve. We were underweight credit. and that produced some nice relative returns in what was a very challenging absolute return environment for fixed income. We flipped the script on some of those narratives. We've now leaned a little long, but we have not added credit. The biggest question that we get from clients is, when will you become more constructive on high yield? When will you become more constructive on corporate credit to include investment grade? And as based upon my prior comments, we're not there just yet. But there's a lot of people interested because the absolute yield levels are quite a bit higher now after what happened over the last, say, 18 months. That said, the spreads have tightened. We've had a bit of a risk-on rally in relative value for mid to lower quality credit and fixed income. So we still think the right trade is to be up in quality at this juncture.
RJ, how about international here, both developed markets and emerging markets? How are you guys kind of allocating capital there?
So within our multi-sector portfolios, we certainly cross borders. We have some currency risk. We own some EM. Recently, we've been overweight emerging markets and captured some of the relative value improvement, some of the spread tightening that had occurred there. And then we have, again, peeled it back. China's data, as we've seen, has disappointed. Some of our analysts who focus on China had argued months ago that the excitement around the pandemic reopening that occurred in China was overdone, that the underlying weaknesses, particularly in their real estate sector and where they've been committing capital and their willingness to see growth slow, ultimately would produce some organic slowdown after you got through the ebullience related to the post-COVID reopening. I mentioned China because I think that radiates throughout the EM marketplace, certainly through commodities markets. We think that there's a general slowing trend in terms of the fundamentals on the EM side, and the valuations had improved very nicely in the most recent risk-on run. So we peeled back to neutral there, still looking for the next trade on that front.
RJ, we only have about 30 seconds left, but ahead of the Fed's decision next week, do you think the Fed can actually pull off a soft landing here for the economy?
It's a top question in all the markets right now. I think the odds-on bet is no. The Federal Reserve has tightened drastically. We don't believe that the monetary policy transmission mechanism has somehow been muted to the point where the over 500 basis points of Fed tightening that we think will be done by the end of the July FOMC meeting, we believe that that's going to lead us into a mild recession. We don't think the base case is for the soft landing. And the soft landing narrative has really underpinned some of the risk rally that we've been seeing in fixed income lately.
All right, RJ, great comments there. Really appreciate getting your thoughts. RJ Gallo, Senior Portfolio Manager, Federated Hermes, taking a little bit more of a cautious approach than I think we hear from a lot of fund managers these days, but it's great getting both sides of the story. We're going to have more coming up. This is Bloomberg. Right now, let's get some company news with Steve Rappaport.
Hello, Paul. Shares of Tesla open higher after the EV maker rolled out its long-awaited Cybertruck. Bloomberg's Ed Ludlow reports.
This is 2 years behind schedule. I'll never forget being in Los Angeles for the unveiling of the Cybertruck. You know the images, the metal ball against the window and it's smashing. And the plan at that time was to start production within 2 years. Well, it's kind of almost 4 years down the road. Deutsche Bank forecasts that Tesla will ship around 2,000 units of the Cybertruck this year. But in the scheme of things, they're also forecasting that overall Tesla will ship 1.78 million units.
Thanks, Ed. David's Bridal avoids shutting down thanks to a court-approved sale. More on that from Bloomberg's Gina Cervetti.
David's Bridal will reportedly be able to keep about 200 stores open after a bankruptcy judge signed off on the sale of the stores to Scion Investment Corporation. That's according to the Wall Street Journal, which reports that the judge said the deal would save thousands of jobs. David's Bridal filed its second Chapter 11 bankruptcy in April, and at that time had nearly 300 stores. Gina Cervetti, Bloomberg Radio.
Gina, as part of the deal, Scion has agreed to take over certain existing liabilities and pay for the cost to cure contract defaults and breaches. Need something quick from the convenience store? Well, Uber has a new partnership that will expand delivery from the stores. The company has teamed up with Vroom. They say Vroom's partner chains represent over 3,000 stores in almost 40 states. Those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets with Paul Sweeney coming up right after this.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Following last week's historic market gains, the S&P 500 right now slightly higher. Since the start of the year, global stocks, they've rallied to the tune of $10 trillion. That's trillion with a T. Now comes the big test. Earnings. S&P 500 firms expected to post a 9% drop in profits in the second quarter overall, making it the worst earnings season since 2020. Treasury Secretary Janet Yellen telling Bloomberg in an interview, growth has slowed, but the labor market continues to be quite strong in the U.S. I don't expect a recession, she says. Expedia launching a loyalty program across 3 of its flagship brands. One key that's going to allow travelers to use and earn rewards. For example, you build up points on the vacation rental platform Vrbo and then use them to book a flight on Expedia.com or a room on Hotels.com. S&P 500 right now, 10 points higher. That's up 0.2%. 45.15 on the index. The Dow Jones Industrial Average is up 65 points. And the NASDAQ 100 right now, 60 points higher. That is up 0.4%. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. Where else? Right here on Bloomberg Radio.
Thank you,
Paul and
JT.
Jess.
We appreciate it. I want to get straight to our next guest,
absolutely.
Paul, who is just all over it when you're talking about where the economy is headed. None other than Anna Wong, chief U.S. economist with Bloomberg Intelligence, who is joining us on Zoom to discuss her latest piece. And when it comes to the upcoming economic data that's out, especially even though it's lighter on the Fed speak front since it is a blackout week, but we do have retail sales on Tuesday. And then we also still have other gauges on the housing front when it comes to housing starts, permits, existing home sales. And then on the back of that, CPI data and producer prices last week. So Anna, talk to us about what we saw last week with those pivotal inflation prints ahead of the Fed's decision next week and what you think this means for the direction of the economy.
Yeah, so we saw a very soft CPI print last week, but everybody's asking, is it just a fluke? And I think the answer to that question is the economy speeding up or is it slowing down? And this week tomorrow we're gonna get retail sales. And as I've been telling Paul here, that Greenspan's favorite indicator, carport shipments and railcar loadings have been flagging a slowdown, significant slowdown in goods spending by consumers for a while now. And I think what we're going to see tomorrow with retail data is that you're going to get a pretty decent headline number partly because there's still inflation and also cars. People still have this pent-up demand for cars. But then all the other thing else, which is excluding gasoline, excluding cars, this is what we call the control group of retail sales, which goes into the calculation of GDP. That number is going to be weak. We expect on a nominal basis, a 0.1% monthly rise adjusted for inflation. That would be a negative print. So I think, and that kind of forecast is underpinned by our assessment that the bottom 50% of the Americans are feeling increasingly financially stretched. You know, you have student loan payment coming due starting in October. And then there's also people are no longer getting that extra money on food stamps that they have been getting during the pandemic. All these pandemic policy that kind of softened the helped buttress the consumers' finances, give them more money. All of that is slowly rolling away. And this is where the monetary policy lags started kicking in. And I think that means that ultimately July would be the last rate hike for until at least a couple of months. And our baseline is for the Fed to hold at 5.5% until the first half of next year.
All right, Anna, Jess and I were just chatting with a fixed income portfolio manager, and he's not buying the soft landing thing at all. He thinks it's going to be a little harder than people think. And, to this eternal optimist, equity analyst, it just seems like that's kind of a harsh read. Where are you on kind of how this economy is the glide path of this economy?
Yeah, I'm not very optimistic about soft landing either, precisely because I look at the finances of the lower 50% of the population. and it is just not good. Now keep in mind that the stock market is booming, the housing market is seeming stabilizing, and that's why all these soft landing people are cheering. But note that most Americans don't own stocks. Like the top 10% by income in U.S. holds 90% of the top stocks, where the bottom 90% hold only 10% of stock, yet they account for 80% of U.S. consumption. So which means that if you're thinking about the health of the real economy, it is the poorer household that counts, and they are just not doing well.
So on the back of this inflation data that we got last week, does this mean that's not enough for this to be the Fed's last rate hike, since clearly they have indicated that they think that there still will be 2 more when you're thinking about Powell and these other central bankers, as well as what's been included in the dot plots?
Yeah, so the latest, the most influential Fed official speech, I would say, is coming from Chris Waller last week, and he's on the hawkish side of the spectrum, right? And even he said that if we are going to see 2 more inflation print, that's kind of like the one we saw last week. So this is before by the time of the September FOMC meeting, right? There will be 2 more CPI print. Then the case could be made that there doesn't need to be another rate hike, and July would be the last. And our forecast is currently pointing to, indeed, 2 more CPI print later that would be similar to the ones we saw last week, because as I said, the consumer is not doing well. The median American is not seeing this booming gains from the stock market.
What about, because to your point, we're going to have a batch of data after this July decision in between. So September 20th would be the next decision day. So you have a couple more CPI prints, producer prices, PCE, but then also on July 28th, 2 days after the Fed decision, there's also the employment cost index, which Powell is watching very closely to gauge wages. With that much inflation data coming ahead of the September meeting, where do you think the trajectory of that data really points to? And do you think that could be enough for them to signal at that September meeting, which obviously comes with the quarterly projection and the dots? We won't get those next week, but will that be enough for them to signal at that point that maybe they're close to actually being done?
Yeah, exactly. So the ECI likely will show that wage growth has slowed quite sharply, and because last week we saw the Atlanta Fed wage tracker came down pretty sharply, and that is the closest proxy to ECI if I have to think about a close substitute. And also on top of that, leading into the September FOMC, BEA is going to revise the PCE inflation data, and we are expecting that the revision in September will show that inflation in the first half of this year, in fact, was not as strong as it seemed, and further providing another data point of supporting not hiking in September or thereafter.
All right, so let's talk. I'd love to get your kind of view on the consumer right here. Anna, we're going to have the retail sales tomorrow, and that'll be a good indicator. And of course, we'll hear from some of the other consumer-facing companies and their earnings coming up over the next couple of weeks. What is your take on the U.S. consumer?
I think that the median consumer is not doing well, and that the strength in when people talk about resiliency in the consumer, they're thinking about the top 20 percentile, the white collars who quickly found a job after they're laid off from tech. Earlier this year, we did see that the higher income consumer were less optimistic about the future. But now we have seen this turnaround where the upper income are more optimistic, and it's the lower income that's not optimistic. And ultimately, it is that big chunk of 60% up to 80% of by income, the lower half, that will determine the fate of the economy.
I wanted to follow up because you were talking about those revisions to the PCE data. It's interesting because earlier this year we had obviously the reweightings when it came to the CPI data. I was curious when it comes to CPE, since obviously that's more of the Fed's preferred gauge when it is measuring inflation. What particular groups, how could that be revised in a particular way that could potentially maybe mask, like you were talking about, some of the strength that we did see? Because obviously it doesn't have as big of a shelter and housing component than like CPI actually does.
Yeah, so this is a very nerdy in the weeds kind of details. But earlier this
that's what we like.
We like it.
Earlier this year, the CPI BLS revised the seasonal factors of the CPI, but and the PCE is actually takes as input of CPI and PPI and a little other thing in coming up with the Fed's preferred inflation index, the PCE. So, but when PCE is calculated, they didn't take on board of all of the seasonal factors, and so they will only completely take on board of all the seasonal revisions in September of this year, and that should, according to our calculation, that means that earlier this year, in the first half of this year, the year-over-year PCE inflation is probably overstated by about 0.2 to 0.3%. Percentage point. And as we get closer to September, this effect kind of dissipates. But what the December revision will show is that in the past year, inflation was probably not as high on a year-on-year basis as we are seeing.
All right. Anna Wong, that's going into the weeds. We appreciate that. Anna Wong, Chief U.S. Economist for Bloomberg Economics. I think Anna's comfortable in the weeds. She gets her undergraduate degree in economics and statistics from Berkeley. All right, so immediately we're not hanging in the same social circus around the Berkeley campus. And then she goes and gets a PhD in economics from the University of Chicago, like the most rigorous program anywhere in the country. Produces some of the best economists and best finance folks out there anywhere. So good stuff. Right now, let's head down to Washington, D.C. Nathan Hager's got world and national news for us.
Thanks, Paul. The penalty phase has officially begun for the gunman in the Tree of Life synagogue mass shooting in Pittsburgh. A federal jury ruled last week that Robert Bowers was eligible for capital punishment in the deaths of 11 worshipers in 2018. Now opening statements are underway, and there will be more testimony on whether Bowers should be put to death or spend the rest of his life in prison. President Biden had promised to abolish the federal death penalty during his campaign. The Justice Department, though, has indicated in this and other cases that it will pursue capital punishment if warranted. China's economy may be slowing down, but Treasury Secretary Janet Yellen says she doesn't see that leading to a U.S. recession.
Wage growth is moderating and inflation is subsiding, so I think we're in a good path on the United States.
Speaking exclusively with Bloomberg Radio and Television from the G20 meetings in India, Secretary Yellen also said China hasn't addressed the unfair trade practices that led to higher tariffs during the Trump administration. She says there is a good chance that the Biden administration will go ahead with limits on outbound investments to China. Another sore spot for U.S.-China relations could come to the surface next month. That's when Taiwan's vice president is due to make a stop in the U.S. on his way to South America. A similar stop for current Taiwan President Tsai Ing-wen led to stepped-up Chinese military drills around the island. The Hollywood actors' strike is now coast to coast. Members of the Actors Union, SAG-AFTRA, picketed outside the Manhattan offices of Netflix this morning. Streaming revenue and artificial intelligence are the big sticking points that have writers and actors off the job at the same time for the first time since 1960. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And we are adding to some of the earlier gains we saw. Shares of Apple and Tesla helping lead the way for stocks. That follows last week's historic rally. You have financials, the best performing industry group in the S&P 500 right now. Last week's CPI print that could signal the turning point in the Fed's inflation fight. As for the rate hikes, economist Dennis Gartman says it's going to be one more and done.
There's no question that they will raise the overnight Fed funds rate by 25 basis points when they meet next week. That's absolutely beyond question. They've made it abundantly clear that will happen. Whether they go another 25 basis points at the September meeting is open for debate. I have my doubts as to whether they shall or not. I think that 5.25 to 5.5 is probably as high as the terminal rate shall go.
Well, right now, the S&P 500, 13 points higher. That's up 0.3%. We're at 45.18 on the index. The Dow Jones Industrial Average is up 78 points. That's a rise of 0.2%. The NASDAQ 100 right now, 90 points higher. That's up about 0.6%. Lawyer involved in the case says Microsoft and regulators in the UK have held what he calls productive talks on the potential remedies to the tech giant can offer as it seeks to clear the final hurdle to its $69 billion acquisition of Activision Blizzard. Apparently, one of the things they also had to agree with what platform, say, Call of Duty. They're not going to change it, so it can only be played on the Xbox.
Right, yeah.
It has to continue to
be available on all of them.
I know you're really into this, aren't you?
Oh, I am.
Have you played Call of Duty?
I have, but it's not like an everyday thing.
You're not telling us you're a gamer, John.
No, I am not a gamer.
Okay, well, we weren't going there.
I was more into like the Nintendo, Sega.
I'm more of a reader.
Reader.
Yeah,
that
If they
too.
have a book about Call of Duty, I might read that.
All right, John Dunker, thank you so much. We appreciate it. Jess, I don't know about you, but I want my airline pilots to be happy people. When
Yes.
they climb into the cockpit, I don't want them to be angry
Absolutely.
with the world. So that's why I saw this news today as good news. I mean, United and their pilots agree to some new pay deal. It could be as much as 40% higher over a period of time. That's good news for the pilots. What's it mean for the airlines? Let's check in with George Ferguson. He's a senior aerospace, defense, and airline analyst for Bloomberg Intelligence. But let's be honest, his career peaked when he graduated from Penn State. It's been all downhill after that. George, so do you have to go back to your earnings models for all your airlines and kind of cut earnings estimates because you have to raise the labor costs so much?
Hey, Paul, thanks for having me on. You're right. It is where I peaked, is when I graduated from Penn State. But no, we don't, is the good news, I guess. Delta already had, a similar agreement on the table. It was 18% increase in year one, which is this year, retroactive to the beginning of the year. So all those United pilots are probably going to get pay retroactive back to Jan 1. So they're really happy because they've been working for 18% more since the beginning of the year. Then they get another 5% at the end of the year, 5% a year after that, 4% the year after that, and 4% the year after that. So all the airlines have been accruing for this, right? They've roughly been accruing for the Delta amount. So what they reported in 1Q, labor costs going to be pretty similar in 2Q on a per seat basis.
Hey, George, we did mentioning when it comes to Delta, did boost its profit forecast last week. Not surprisingly, on this rebound in global travel, we'll hear from United Airlines and American this week, Southwest next week. What are you expecting from these other groups that we're going to hear from shortly?
Yeah, so I think Delta really confirmed for us that the strength in 2Q was all about Europe, right? 17% increase in yields, which are like fares going to Europe. So I think that's really gonna have a major effect on American and United. And what we saw in the Delta release was that yield growth for the domestic business was flat from last year. And so we think, you're gonna see the biggest earnings bounce again at Delta, American, United. But when you get into the airlines that are a little more domestic focused, they're not gonna get that big of a bounce because it feels like maybe the post-pandemic sort of, travel bounce back has happened here in the States mostly. And now it's all about folks who haven't been to Europe in 4 years being willing to pay whatever it takes to get there this summer.
So domestic travel waning, but not internationally, which Paul's daughter, I believe, was just in London.
So, George, I mean, talk like in terms of the labor situation here. I see a labor contract like with the pilots and United, and I got to think that the airlines just had to pay up because they have to attract more pilots. Is that the case for the pilots? Is that the case for other segments of the industry?
So it's not, right? I think the pilots are really a special situation because it takes so long to train a pilot and bring him into bring him into an airline. So we're seeing wage inflation for the rest of the airline's employees. Mid-single digits, high single digits. But pilots are going to be a persistent problem, right? When we look at the pool of pilots, they're aging. We actually see probably not peak pilot retirements until 2026. And so the airlines, I think, like you said, had to pay up. And I think they also have to really think about what their recruitment tactic is going to be, right? If you're a smaller airline, if you're a regional airline, if you're a fractional operator like a NetJets, I think it's going to get pretty hard to recruit talent as far as front seat pilot talent over the next 3 or 4 years.
Looking at the CPI data from last week, it was actually signaling that airfares were lower. What do you think is happening with those airfares? And is it obviously a difference if you're looking domestically versus internationally?
Yeah, so I think it is different, the domestic versus international. And remember, the majority of revenue is earned by all these airlines domestically. So they get a nice tailwind out of Europe. But domestic is, again, we see flattening in 2Q from Delta. And we had seen for a period of time here, all through the second quarter, where domestic fares were, they're not falling precipitously, but they're nosing over and coming down. Again, another indicator to us that maybe this leisure bounce is over. I think a big challenge for the airlines will be, does business come in 4Q and 1Q when leisure usually typically softens pretty heavily and support these earnings, or is business still at 65 to 75% of the transactions they were doing in 2019?
Yeah, I mean, that goes to my point, George. My personal policy is I'm not flying unless somebody pays me to fly. That's how bad it is out there in terms of the airport. I'm not sitting on the tarmac in Newark again. So what are the airlines realistically telling the street about business travel? Is this a structural reduction in the level of business travel? We're going to reset at a lower level and then see if they can grow from there?
So I don't know that they've, I don't think they've capitulated that far and said that it's sort of refashioned in the future, not going to get back to what it was in 2019. Delta's commentary was around, there was the trend was building for more business travel, and so I think they're really hoping it does come back at the levels it had been in 2019. Again, not capitulating on it. I think they're also talking a bunch about how they're upselling to leisure, putting more leisure folks up into the front of the airplane. Our analysis is that isn't at the same price point as business. So while I think it's a good tactic, right? You want to generate as much revenue, per seat as you can. I don't think it's going to generate the level of revenue they used to get out of business. So I think for sure the big full service carriers, Delta, American, United, really want to see business come back as strong as it was right before we entered the pandemic.
And George, we only have about 45 seconds left, but have to ask you about aerospace and defense companies because we do have Boeing and Airbus reporting their results next week. What are you expecting to hear from them?
Yeah, so Airbus and Boeing both had really nice deliveries, numbers of deliveries in June. I think they'll both probably beat consensus as we get, in the second quarter because just seeing a good amount of commercial deliveries. I don't think they're out of the woods yet on supply chain, so there's still probably bumps in the road as we go through 2023, but it'll be a nice quarter, I think.
All right, George, thanks so much. We appreciate that. As always, George Ferguson, Senior Aerospace, Defense, and Airline Analyst. Anything that flies, George is on top of it. He does that for Bloomberg Intelligence. He's also a retired U.S. Army officer, so we thank him for his service. And the MBA from Rutgers, which is the State University of New Jersey. George does it all. S&P 500 up 0.3% here. NASDAQ up 0.7%, so a little bit lift there. Russell, I'll note that, the Russell 2000 up over 1%, 1.05%, so the small cappers having a nice outperformance today. We'll have more coming up. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, the union representing UPS workers, asks the Biden administration not to intervene in the event of a strike. Bloomberg's Joan Doniger reports.
Steve, with the deadline for a new deal just 2 weeks away, Teamsters President Sean O'Brien on Sunday told members to prepare for a strike as the union pushes for higher part-time wages. He also urged the White House to stay out of it if workers walk out.
The White House shouldn't be concerned with the Teamsters. They should be concerned with corporate America, who keeps making billions upon billions of dollars off the sweat of our members.
O'Brien, in a webcast with members, said the Teamsters will continue working if a tentative deal is reached before August 1st. Steve?
Thanks, Joan. Shares of UPS currently down less than 1%. A lawyer for the UK's antitrust regulator says the agency held productive talks today with Microsoft on potential remedies the company can take to clear its proposed acquisition of Activision Blizzard. Bloomberg's Alex Webb has more.
The target is for it to close tomorrow. So the UK is really up against it. The UK regulator, the CMA, if it wants to stop that deal, they have sort of issued a kind of stay of execution in a sense by giving them scope maybe to make some more concessions. It seems as though the concessions are going to be the way that Call of Duty in particular is sold for online gaming in the UK, for cloud gaming.
Thanks, Alex. Home prices were still rising in the spring. Fannie Mae says single-family home prices rose 3% year over year in the second quarter. The prior quarter, the annual increase was almost 5%. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg. Stay tuned for more Bloomberg Markets coming up next.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Mann and Paul Sweeney here in our Bloomberg Interactive Broker Studio. Looking at this market, we have the S&P 500 up 0.3%. NASDAQ up at 0.7%. And again, as I called out before, the Russell, the small cappers up 1.09%. So nice move there. Looking at trading in the currencies here, the Bloomberg Dollar Index a little bit higher today, so we note that it's come off its recent highs, so we keep an eye on the dollar there. Right now, let's head down to Washington D.C. We get world and national news with Nathan Hager.
Okay, Paul, the Northeast is starting to dry out from 2 rounds of heavy rains in the space of a week that sparked flash floods from Pennsylvania into New England, and in Connecticut left hundreds of acres of crops underwater. This is Connecticut Senator Richard Blumenthal.
In the Northeast, we know many of the produce farms will grow strawberries, peaches, apples, corn, multiple crops, not like the big mega farms out in the Midwest that just grow corn or they just grow wheat.
One flash flood in Bucks County, Pennsylvania left at least 5 people dead. Authorities there are still looking for a 2-year-old girl and her 9-month-old brother missing in that disaster. Overall, there is an 80% chance this year will be the hottest on record. That's according to the nonprofit Berkeley Earth, which has been tracking each month's global temperature since October of 2019. This last month was the hottest June on record. So far, July has 10 of the hottest days since scientists started keeping track in the 1800s. Russia has terminated the deal that has allowed Ukraine to export grain during the war. Bloomberg's Amy Morris has more from Washington.
The move heightens uncertainty over global food supplies and escalates tensions in the region. Interfax reports Russia notified Turkey and the United Nations, which brokered the pact, that it won't extend the deal. Moscow had said it will return to the agreement once its conditions are met. The corridor's shutdown will hit key buyers China, Spain, and Egypt, and jeopardizes a trade route from Ukraine just as its next harvest kicks off. Ukraine is one of the world's top grain and vegetable oil shippers. In Washington, I'm Amy Morris, Bloomberg Radio.
In the meantime, we're just getting word President Biden is set to meet with a high-level Catholic official to discuss forced displacement of Ukrainian children by Russia. The Vatican announced today that Pope Francis has dispatched Cardinal Matteo Zuppi to Washington for a 3-day visit after recent trips to Kiev and Moscow. Sources tell Politico the Cardinal will meet with President Biden tomorrow. Vice President Kamala Harris's husband, the second gentleman, Doug Emhoff, he's getting ready to head to New Zealand this week to lead the U.S. delegation to the Women's World Cup. Emhoff tells ABC's Good Morning America he's looking forward to a Team USA three-peat.
We all want the three-peat, but they're going to take it one game at a time. They're going to be focused. They're going to be disciplined. They're going to be determined. And I really believe they're going to bring it home.
Second gentleman, Doug Emhoff, also says he's going to take part in several events in New Zealand to promote gender equity in sports and across society. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nathan Hager in Washington. This is Bloomberg. Paul and Jess.
Thank you, Nathan. We appreciate it. Jess Mitten, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And a column I always like to read in the mornings is from Macro Man, Cameron Christ, that we all know on the terminal. And his latest column is talking about how the equity option expiry week is usually quiet. And he's thinking, especially because at the end of this week, just given that next week we have the Fed, the Bank of Japan, the ECB all having these different policy decisions, might not be quite as volatile as typically people would think, and especially investors, just given what's ahead the following week, Paul.
It used to be that when you get these triple witching hours or even quadruple, it would move the market. And it seems like it's less so now. And I know there's a reason why, which I'm not aware of, but it just seems like they used to really move the markets here. But again, for folks that are out there in the markets, they certainly pay attention.
Right, and definitely when you know it's coming ahead of time, that obviously gives you a bit of an indication there to kind of, especially positioning-wise, you know it's coming. It's not necessarily a surprise. But then also looking at the expiry of VIX futures on Wednesday, that actually happened, and what that means for equity and index options on Friday. So that'll be key things that investors are going to be looking ahead to this week.
All right, so we've got a little bit of eco news. We got a lot of earnings news over the next several weeks, starting really in earnest tomorrow. It's going to be a busy, busy week. Some more banks and some more big cap names. And on my bailiwick on the media front, I'm going to be paying attention to Netflix on Wednesday after the close.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, coming up, we are going to listen into a very interesting interview that Bloomberg's Washington correspondent, Anne-Marie Hordern, had this morning with Treasury Secretary Janet Yellen. It was an exclusive interview from the G20 summit in India, talking about China, talking about global growth and global economics. So we're going to take a listen to that. Plus, we're also going to speak with Julie Gorte, Senior VP for Sustainable Investing at Impacts Asset Management. All that coming up in this hour. First, let's go to Charlie Pella, kick it all off with the Bloomberg Business Flash.
Very much, Paul Sweeney. And on this Back to Work Monday, we have got stocks trading very close to session highs right now. 14-point gain for the S&P. Right now, we're at 45.20 midday. That is an advance of just about 0.3%. The Dow's up 70 points now, up 0.2%. NASDAQ up 103, up 0.7%. The Russell 2000 up now by 1.1%. 10-year yield 3.81% with a 2-year that's at 4.74%. Spot gold down 80 cents the ounce right now. Gold is at $19.54 the ounce, and crude lower by 1.3%, 74.44 a barrel. Well, this morning we did get a report showing gross domestic product in China grew at a slower than expected pace of 6.3% in the second quarter, adding to risks for the global economy reliant on Chinese spending. Earnings front and center among the big banks reporting tomorrow will be Morgan Stanley and Bank of America. So what to expect after last week's reports out of JP Morgan Chase, Citigroup, and Wells Fargo? Allison Williams is a senior bank analyst with Bloomberg Intelligence, and she was our guest right here on Bloomberg Markets.
It looked like the banks were being conservative with guidance, and so they upped that guidance. So we're going to see if the same holds true for Bank of America. Part of that is that they're growing credit card loans, which are higher yielding. And if you look at loan growth, that's really been the strong point that benefits big banks like JP Morgan, Citi. Wells also growing that a little bit. Bank of America, we'll see. But Bank of America does have a little bit more exposure to the commercial and industrial side.
And you can hear more of that conversation on the Tape podcast. You can download it wherever you get your podcast. Bank of America ahead of earnings, up today by 1.2%. Morgan Stanley up 0.9%. Goldman Sachs lower, little change, down less than 0.1%. Recapping, a move higher for the S&P, up 14 right now, up 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie Pell, thank you so much. We appreciate it. Jess Met and Paul Sweeney here in the Bloomberg Interactive Broker Studio. And guess what? You can now stream this whole production live, the video live on YouTube. Just go to YouTube and search Bloomberg Global News. Now we want to take you to India. Bloomberg's Anne-Marie Hordern spoke exclusively with U.S. Treasury Secretary Janet Yellen earlier this morning about geopolitics and the U.S. economy. Let's go to that conversation.
You join us now from India, where you're meeting your counterparts. It's the G20 finance ministers and central bank governors meeting. And really the cloud around this meeting is the fresh data we got out of China today. Beijing slowing momentum in their growth. Citi is talking about the growth target being at risk. I'd like to start, Treasury Secretary, with the fact of whether you think this means there could be an increased chance of a U.S. recession.
Well, you're talking about the slow growth number from China. Is that right, Anne-Marie?
Yes, correct.
So I think China has seen slower growth than they expected upon opening up from COVID. Consumer spending has been relatively weak. It looks like consumers are more focused on building back their savings buffers. And so growth has been slow. And as you know, youth unemployment is quite high there. So I think the Chinese are concerned about sluggish growth in their economy.
But what does this mean for U.S. growth and global growth overall? Is the soft landing in the United States still your base case scenario?
Well, many countries do depend on strong Chinese growth to promote growth in their own economies, particularly countries in Asia. And slow growth in China can have some negative spillovers. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging, that we're making progress on getting inflation down. But as I'd hoped and expected, that would occur in the context of a strong labor market, and we continue to see that. The fact the labor market's been so strong has encouraged more prime-age people to enter the labor force and to work, and that's helped take a bit of the heat out of the labor market. The fact that growth overall is slowed after we enjoyed a rapid recovery, that's normal, but it's also led to some reduction in the desire of firms to hire. Still lots of job openings, but wage growth is moderating and inflation is subsiding. So I think we're in a good path on the United States.
Okay, so it sounds like soft landing is your base case, and you don't think we're going to see a recession. Yesterday, when you were speaking to reporters, you talked about this de-escalation with China, and you ruled out lifting tariffs as part of this de-escalation with Beijing. So what is on the table?
So, several years have gone by in which we've had COVID lockdowns, especially in China, and very limited contact between senior officials in the United States and China. And we now have a new economic team in China that we need to establish relationships with. We need to get our relationship back in a more stable place, put a floor under it, and try to promote better understanding between our countries. So I recently made a trip, met with a number of senior Chinese officials, including the new economic team there. We had very candid discussions. Each side raised a series of concerns. Chinese certainly mentioned their concern with the tariffs that we have in place. But we had constructive conversations, deepened our understanding and of the economic situation and of our concerns. We're able to address them and agree that there are a broad range of global challenges, particularly debt and climate change, that affect the entire global economy that we need to work on jointly. And I'm hopeful we'll be able to do that more successfully. On tariffs, we put tariffs in place on China because we had underlying concerns about unfair trade practices, particularly those affecting intellectual property and technology transfer. And those concerns really have not been addressed. We're undergoing a 4-year required review of tariffs. And of course, China also retaliated, putting tariffs in place on us. We have to see what comes out of the 4-year review. But I would emphasize that really the underlying concerns we have not yet been addressed, and we need to work on that going forward.
But when you're looking at de-escalating, we're trying to figure out what would be left on the table, because what it feels right now is the administration is actually just amping up when it comes to potential tit for tat with Beijing. There is the outbound executive order that potentially we could see as soon as the end of July or this summer. Could that be a place, pulling a punch from the outbound executive order, maybe making that a little bit more toned down? Could that be a place you could de-escalate with Beijing?
Well, first of all, I want to say that what we're doing is not tit for tat. What we're doing is putting in place controls that are designed to protect U.S. national security and, in some cases, to address fundamental human rights abuses. And we do intend to protect our national security. We have export controls that play an important role in accomplishing that. And what I tried to explain to our Chinese counterparts is that our desire is to make these U.S. policies clearly national security focused, transparent, and narrow. That we're not attempting to stifle economic progress in China, that we have and want to continue to have deep economic ties. After all, this year our trade has reached almost $700 billion. We feel
but if
that
the national security
we have
concerns,
a healthy economic.
Madam Secretary, if the national security concerns are so important, Jake Sullivan called for this outbound executive order 2 years ago. Why is it taking the administration so long?
So we are looking carefully at outbound investment controls, and they would serve as a complement to the export controls that we have in place to make sure that we've covered all the channels by which technologies can be transferred to China that we think pose national security concerns. I explained to my Chinese counterparts that if we go forward with these, they would indeed be narrowly targeted. They would focus on a few sectors, in particular semiconductors, quantum computing, and artificial intelligence, that they would contain a combination of notification requirements and, in very narrowly scoped portions of these sectors, prohibitions. But these would not be broad controls that would affect U.S. investment broadly in China or, in my opinion, have a fundamental impact on affecting the investment climate for China. So these would be national security focused.
It sounds like it's already done. Is the administration have it finished and is just waiting for a good time to release it?
We want to make sure if we do this that we get it right, and we've been working on the details. If we do go ahead, and there is a good chance that we will, that we would put out, along with the executive order, a notice of proposed rulemaking so that the public would have a chance to comment on these proposed controls, and we would receive a wide range of public input before finalizing anything that we do.
Madam Secretary, you obviously have a lot on your plate when it comes to re-engaging with China and your discussions there just off this trip from Beijing. I'm curious how difficult the dialogue is going to continue to be after the revelations about the Chinese hacking of your colleague, Secretary Gina Raimondo.
So I do have concerns about hacking of U.S. government officials or private individuals or companies, and I know the United States has expressed those concerns, but we intend to continue to deepen our discussions with China to increase our engagement. It's especially important to explain what our motivation is, to avoid misunderstandings that can lead to unnecessary and dangerous escalation. President Xi and President Biden agreed in Bali that senior officials, including those in economics, should interact more regularly. And I think an outcome of my trip there was that we will have deeper ongoing engagement at all levels.
When did you learn about the China email hacking? I'm curious if you had a chance to maybe bring this up on your trip to Beijing.
I believe I did not know about that in Beijing. It wasn't one of the things that we discussed.
I also want to ask about what's happening on the ground, something that I know is very important to you, and this comes to debt relief of these developing countries. There has been this push from the U.S. administration to use the Zambia principle for other countries like Ghana, but that's not getting the broad support it needs in India on the ground amongst other G20 finance ministers. Is China the holdup here?
Well, look, we designed, the G20 designed something called the Common Framework, which is a set of principles and processes to deal with unsustainable debt situations. And we would like to see countries that apply to use the Common Framework get rapid relief from their debt that they need in order to grow and be able to attract investment and undertake IMF programs that can help to stabilize their economies. And the few cases that have applied to use the Common Framework, including Zambia, have taken far too long. The process has been onerous, and it's taken a very long time to get debt relief. We are pleased that China has become, China after all is a major creditor of these countries. We have been anxious to see China move more quickly and take a more constructive attitude, participating in these debt relief talks. And getting agreement on Zambia was an important step. China has also been helpful in Ghana, the case of Ghana and Sri Lanka. And I'm hopeful that we'll be able, going forward, to make more rapid progress. I should emphasize that the debt issue is one that concerns the entire G20, and we are united in wanting to see this framework work more effectively, and it is a priority for India as well.
All right, that was Bloomberg's Washington correspondent Anne-Marie Horder sitting down with Treasury Secretary Janet Yellen for an exclusive interview from the G20 summit, India, talking about all things China and the global economy. We want to follow that up with a discussion with Enda Curran. He's a global economy reporter with Bloomberg News. So, Enda, fascinating discussion. Anne-Marie Horder had it this morning with Secretary Yellen here. I mean, the messaging seems to be that the U.S. government's trying to work with the Chinese government, but there is just a lot of challenges out there. What did you take away from this discussion?
Maybe some mixed messaging, I think, coming from the administration, because obviously we know there's been a very hawkish rhetoric. It's all about U.S. strategic rivalry with China, but we had this morning Ms. Yellen making those comments in the interview that you just played, saying, for example, the U.S. will go ahead with those investment restrictions on China, but she doesn't really see it having an overall harmful effect. It's fairly targeted, precision kind of policy, and obviously that will stoke debate over, what exact China strategy is the administration pursuing? Are they trying to get things on an even keel and sort of reach reconciliation, or are they pushing ahead with sort of the hawkish side of things? So I think there's grounds for debate there around some of the signals coming from that. She also spoke, though, about what the Chinese economy is signaling for the rest of the global economy, and she made some remarks during the G20 about how China's slowdown is definitely going to slow down trading partners in the Asia region, but probably won't be enough to spill over to the US and drag the U.S. economy into recession itself. So as I say, covering a lot of ground, but maybe mixed signals from the Treasury Secretary on the China policy.
Something that struck me and Paul was when Yellen was talking about youth unemployment being so high in China. Do you know exactly what drives that dynamic?
Yeah, it's up over 20% now again. On paper, that's a record, but the data doesn't actually go back that far. It only goes back to 2018. There are a few different things at play in China. There's been a record amount of graduates coming on the market. I think it's 11 odd million this year. So they're obviously all going to be looking for work. There's been a lot of change in China's economy in recent years. That big regulatory crackdown on the tech sector, for example, took away some of the low-hanging fruit when it comes to young graduates getting work. That's been cited as one factor. And of course, then you have this broader slowdown. This was meant to be the year of recovery in China's economy. Post the COVID zero policy, services and consumption were meant to drive this big fizz in demand. Well, it looks like that's kind of petering out. It's been a disappointing recovery. Lots of economists now downgrading their forecast for China's economy. Some people even warning that China's government will miss the growth target of around 5% this year. So you would have to say the pressure on youth employment is part of the mix of the broader economic slowdown there too.
So, and how broad and how deep do you think the economic slowdown is likely to be in China? I know it's tough to get reliable data, but the concern is that could have an impact on the global economy.
Yeah, so this was meant to be the year that China would spill over to the rest of the world, as we were just talking about. Chinese tourists would go everywhere and spend money, and Chinese students, and of course Chinese demand for imports from bulk commodities and everything else. But it hasn't really played out like that. And to your point then, on the ground, all indications are, the official data saying there has been a material slowdown there. It's disappointing to the point now where economists are saying two things. China is at risk of deflation, certainly stark contrast to the US there, and also that they may miss the official growth target of around 5% That was considered to be a conservative growth target when it was said that the government could pretty easily meet it, but now that's in danger. So, of course, it's difficult to tell what's going on in China. It's such a huge economy, and there are questions around transparency of data, but consistently it's showing that the real estate sector is in a slump. The consumer rebound story isn't there. The industrial side of things is picking up a bit at the moment, but exports remain in the doldrums. So by all accounts, China's economy is certainly slowing down, and it's a question of by how much.
All right, Enda, thank you so much. We appreciate that as always. Enda Curran, he is just giving us kind of an overview, kind of what we're seeing here on the U.S. and China to try to reset some economic discussions here between the two countries. Right now, let's kind of reset here. We'll get a Bloomberg Business Flash from Charlie Pellet.
Very much, Paul Sweeney. We are off session highs right now, an 11-point gain right now for the S&P 500 index. We're at 4516, up by about 0.2%. The Dow up 53 points now, higher by 0.1%. Nasdaq is advancing 89 points, up by 0.6%. The 10-year yield 3.81%, with a 2-year 4.75%. Gold is down 89 cents the ounce to $19.54, drop there of 0.1%. West Texas Intermediate crude down 1.4%, $74.36 right now for a barrel of West Texas Intermediate crude. And 11-point gain for the S&P, up 0.2. Again, the Dow up 53, up by 0.1%. Ford shares are now down by 5%. The sticker price on Ford's F-150 Lightning electric pickup is being lowered by thousands of dollars due to increased plant capacity, falling costs for battery raw materials, and internal efforts to scale production by the Detroit automaker. Again, Ford down by 5%. Tesla shares, they're advancing now by 2.3%. Again, recapping, we do have stocks higher, S&P up 11. That's a gain of 0.3%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. We appreciate it. Jess Minton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And for our next segment, we're going to talk about sort of scanning for stocks here with Julie Gorty, who's Senior Vice President for Sustainable Investing at Impacts Asset Management, joining us on Zoom to discuss how this record heat is affecting physical assets and which sectors and companies are most at risk. Julie, thank you so much for joining us. Take a step back and tell us about Impacts and what you do.
Sure. Impacts is an investor with we have about $50 billion in assets under management. We're based in London, but we have offices in North America and Asia, so we're a global investment firm. And what we invest in is the transition to a sustainable economy. So everything that we do is aimed at investing in the things that have the long-term value drivers of sustainability.
So give us examples of kind of some of the areas that you've invested in.
So we're investing in the food and ag sector in things that are crops that will be more resilient to heat and to drought. In climate change, we invest in solutions that will mitigate greenhouse gas emissions, obviously wind and solar, but also things like pumps, pipes, filtration, much more efficient heating, air conditioning, and space conditioning. We invest in things that are water saving and that actually help to purify the water, and things that avoid having to use things that allow you to use water in situ, right? If you have to pump your water 50 miles from a reservoir and then back to the wastewater treatment plant, well, water weighs about 9 pounds a gallon and it takes a lot of energy to pump it. So anything you can do to retreat your water and reuse it in situ is going to save you both in terms of water and climate. So ideas like that. Chemicals that are less polluting, stuff like that.
In relation to these physical assets, why is physical climate risk so important, in particular when you want to look at more industries in the stock market too?
Yeah. So when we think about climate risk in the past, we've tended to think about the big emitters, so energy stocks and utilities and things like that. But everybody is vulnerable to physical risk. You can be a non-emitter, but if you're on a coastline that's vulnerable to a hurricane, you can still get affected by climate change. And increasingly, that's happened. We've seen disruptions in air travel. We've seen outdoor work become much more dangerous. There's a high rising mortality rate, and it absolutely affects productivity of both people and other organisms that have to work outside in high heat. You've seen vulnerability of whole economies, local economies, to things like hurricanes and severe weather, coastal storms, sea level rise. All of that stuff can have a major economic impact. Right now, it's having impacts that are running in the hundreds of billions of dollars of insured losses annually, and that's just the insured losses. So double that if you want to, or it could be even higher if we count uninsured losses, and that's going nowhere but up. As long as our emissions are rising, physical risk is rising. That can affect anybody.
You talked about energy. What other specific sectors, industry groups, do you think the stock market is most vulnerable to when you're talking about physical climate risk?
Okay, so agriculture, obviously anything in the food value chain. There are also a lot of electric grids that are vulnerable. That's not energy production, but it's sort of getting the energy to households. We've seen rolling blackouts in California. We saw the Texas grid freeze, basically, go out because of that. But, we can also affect transportation. So we saw, like if it gets hot enough, the asphalt buckles and rails expand. So things like air travel get disrupted by the storms, as well as just by what's happening on the asphalt in airports. So anyone who ships their goods, could be vulnerable to disruptions in transportation. We were just having a call this morning with a really big semiconductor company that ships most of their stuff by air. So air disruptions can matter a great deal to the semiconductor supply chain. If you want to know what that disruption looks like, look at what happened during COVID.
So, Julie, it just feels like, climate change has become such a political issue here in the U.S. I don't know how it is around the world here, other parts of the world. Do you encounter that with your investing, with companies you look at, with your discussions of all the stakeholders out there? And if so, how do you deal with it?
So the backlash in the U.S. primarily, I would say, is primarily political. When we talk to firms about it, when we talk to them about physical risks or transition risks, they get it. Mm-hmm. Whatever the political discourse is, it doesn't affect the facts. Really, it can affect policy. But the fact that physical risk is happening is going to happen whether people believe it or not. So they get it. When we talk to the firms in the S&P 500 about physical risk, the firms that had thought about it understood that the impacts could be severe, unexpected. Making decisions in a crisis, like if you have a hotel full of passengers stranded in the Bahamas by a hurricane, you have to do something to get them out if you're the hotel company. Because otherwise, they're never going to stay at one of your hotels again. So our discussions with companies are usually pretty productive. They understand the importance of climate risk. they understand the importance of doing something about it. And so do our shareholders.
What do companies need to disclose when it comes to these key assets and where the value chain dependencies end up being located?
What a good question. That's exactly what we ask them. So the first thing we need to know is investors, what we're pricing is where the puck is going, not where it is, right? So we need to know what assets are going to be vulnerable to physical risk. And since physical risk, how much physical risk you face and what type depends on where you are. The first thing we need to know is where are your assets? Right, so where are your manufacturing plants? Where are your big distribution centers? What ports does your primary shipping go through? Where are your key supply chain dependencies? So I'll just give you a quick example. Biggest semiconductor manufacturer in the world is TSMC. A couple of years ago, the drought in Taiwan was so severe that they almost had to close down their plant. It takes a lot of water to make semiconductors, very little of which ends up in the semiconductor, but it takes a lot to make one. The government was considering even seeding clouds to try to make it rain. Luckily, the drought ended first, but that could have been really a disaster for them. So the first thing we need to know is where are you, and where are the key nodes in your supply chain so that we can assess your vulnerability. We can run the climate models, and we do, but we need to know what they're going to affect in terms of companies' assets and dependencies. The next thing we need to know is what you're doing about it. So do you recognize what these risks are? And if so, what measures have you taken to avoid being vulnerable during an event, a hurricane, a flood, a wildfire, a drought, an outage in the grid, something like that? Then if we have that kind of information, then we can do our own magic and figure out how to price that risk. But we don't even have physical location information right now.
That's kind of where I wanted to go, Julie, and we have about 30 seconds left. Data. We're Bloomberg here, we're a data company. Is there adequate data for you to really do your job and assess the risk?
No, we can get information on where the risks are, and we know some of the company locations, so we can do assessments. But in order to do a really good job, we'd need to have much better data on location and on companies' management of and recognition of physical risks and how they're adapted.
Julie, thanks so much for joining us. Fascinating discussion, a growing field, of course. Julie Gorte, Senior Vice President for Sustainable Investing, Impacts Asset Management. Kind of going to a risk here as part of the, the broader ESG discussion, which, again, as Julie was just mentioning, has become highly politicized here in the U.S., much more so than in other parts of the world, and making, folks that are focusing on that, their job a little bit more difficult.
Definitely, when people are thinking about how do you invest and approach physical climate risk, as that continues to get in conversations.
Yeah, and what's on the front pages of the papers and these days is just all the crazy weather out there, whether it's extreme heat in the southern part of the U.S., smog coming down, or forest fires from Canada, extreme heat in Europe as well. So it just seems to go on and on. So if you can't, I don't know, we'll have to keep on top of that. Right now, let's head down to Washington, D.C. World and National News with Nathan.
Extreme flooding is my focus at the moment, Paul. The search is expanding for two little kids who are still missing in a flash flood that killed at least 5 people in eastern Pennsylvania over the weekend. Fire Chief Tim Brewer in Upper Makefield Township says the 2-year-old girl from South Carolina and her 9-month-old brother were in the family car when it was swept away.
We have search teams that are assisting us from Delaware, Chester, parts of Bucks County, New Jersey. We also have deployed K-9 units, underwater assets, air assets.
Those weekend storms also led to flash flooding in parts of New York, New Jersey, and New England. Today, the story is the return of wildfire smoke. Not as bad as it was last month when it turned the skies of New York orange, but with more than 580 fires across Canada still burning out of control. The smoke is back in parts of the Northeast and Midwest. Russia has put an end to its grain export deal with Ukraine nearly a year into it. It's raising new uncertainty about global food supplies, and it comes on the same day as another attack on Russia's main bridge to Crimea. Bloomberg's Rosalind Matheson has more.
That's a really important bridge for Russian President Vladimir Putin. Crimea really is a red line for him, and whether he needed a pretext to nix this deal is a question, really. But he's saying that Ukraine, of course, carried out some sort of attack on the bridge today, a drone attack.
Bloomberg's Rosalind Matheson reports Ukraine has not commented on the attack. Mexican President Andrés Manuel López Obrador is criticizing Texas Governor Greg Abbott for putting buoys in the Rio Grande to keep migrants from swimming across. The president, known as AMLO, is calling on Mexican voters living in the U.S. to avoid voting for Abbott or the GOP. Abbott's not up for re-election to a fourth term for another 4 years. Global news powered by more than 2,700 journalists and analysts in over 120 countries.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 12:40 on Wall Street. We do check markets all day long at Bloomberg. Stocks have resumed a rally as investors weigh bets that the Federal Reserve is approaching the end of its interest rate increases against evidence pointing to a slowdown in China's economy. The S&P 500 index does remain higher now by 11 points, up by about 0.3% to 4516. We've got the Dow up 66 now, a gain of 0.2%. The Nasdaq Composite Index up 84, up 0.6%. The Nasdaq 100 Index, full of big tech names, up 77, a gain there of 0.5%. 10-year yield 3.81% with a 2-year at 4.74%. Spot gold, little change now, up 25 cents the ounce. The precious metal at $19.55 the ounce. West Texas Intermediate crude down 1.5%, 74.27 a barrel. Well, as for the overall market backdrop, specifically those big tech names, Hugh Roberts is head of analytics at Quant Insight Limited, and he was a guest right here on Bloomberg Markets.
The mix of growth, inflation, financial conditions, risk appetite at the moment continue to be supportive. The downside is that most of these things, and especially the mega cap Magnificent Seven, have all moved ahead of our model value. So they all screen as rich. So they've discounted a lot of the good news already.
And you can hear more of that conversation on the Bloomberg Tape podcast. You can download it wherever you get your podcasts. Microsoft and Activision Blizzard, the video game empire it's seeking to take over in a $69 billion deal, are edging closer to completing one of the biggest acquisitions of all time. Over the weekend, Microsoft did strike a deal with Sony, arguably the staunchest opponent to the takeover, to ensure that Activision's popular Call of Duty franchise will remain on Sony's PlayStation platform for a decade. Activision shares, they're up now by 3.2%. Microsoft up by 0.1%. Recapping, an 11-point gain right now for the S&P 500 index, up 0.2%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie Pell, thank you so much. We appreciate that, as always. Jess Menton and Paul Sweeney here in our Bloomberg Interactive Broker studio. Of course, simulcasting this thing live on YouTube. Just go to YouTube and search Bloomberg Global News. All right, let's talk about the business of sports. And this is a good one. The Fenway Sports Group. You know them. They own the Boston Red Sox.
Pittsburgh Penguins.
Pittsburgh Penguins.
Liverpool
and Liverpool Football Club, plus some other businesses. And I'm a Yankee fan, full disclosure, but Yankee fans have a lot of respect for Boston. We know how good they are because we have to play them like 17 times every year. Let's talk about the business there. Julie Swinehart joins us. She's the CFO and EVP of Fenway Sports Groups, joins us via Zoom. Julie, thanks so much for joining us here. I want to talk to you about the real business of sports. And the part of it that I know well is the regional sports networks that support some of these regional sports like Major League Baseball, like NHL hockey. The regional sports network business is in a world of hurt. The biggest one just filed for bankruptcy. Revenues are down dramatically because everybody's cutting the cord. How do you guys deal with it at the New England Sports Network? And how are you kind of dealing with those changes?
Well, thanks for the question. First and foremost, thanks for having me today. It's great to speak with both of you. Regional sports networks are in a time of change, I'd say, for sure right now. New England Sports Network, our ownership team supported them and really encouraged them to try to get ahead of what's happening, as you described, in the marketplace. So we were, I believe, the first to market with a direct-to-consumer product, which launched just about 12 months ago. And so that's one way that NESN is trying to stay ahead and stay relevant and successful. And I think there's been a lot of early wins with DTC, a lot of learning as well, but more to come there. And I think that's one way that we can try to combat some of the headwinds out there that are just part of the landscape.
So what does it take to fund a winning sports team? Where does the revenue come from?
Well, I don't know how nerdy you want me to get with revenue streams, but coming in, and I've been here just about a year, there's been lot of learning, but a lot of aha moments for me. And there's more similarities across the different teams in terms of the revenue structure than I guess what I would have originally expected. But there's the obvious, media revenue sources, there's sponsorship, partnership, advertising revenue, depending on which entity we're speaking about, and then also game day or match day sales. So fans coming to the venues and spending money on concessions and whatnot. So, but each of the teams have a little bit of a different makeup across the revenue. And really what keeps it all going is, as I think is probably pretty intuitive, is the excitement around winning. And we are here to win championships. And I think we've demonstrated with John Henry and Tom Werner and Mike Gordon and what they've built here, a really winning track record that allows us to do all those things.
Talk to us about the Liverpool Football Club, the English Premier League. It's such a global business, a global brand, a global game. Talk to us about kind of your experience owning this. I think you guys have owned this club for almost a decade now.
Yeah, a little over a decade. And, I think the investment over time, we take a long view on all of our investments and a very intentional approach in terms of trying to elevate and make the teams more successful, make them better. Liverpool does have a global reach, and they're one of our many important assets. So it comes with just the right amount of support from the FSG entity, always listening to the supporters and the fans and trying to get input there from what they're looking for, what's important to them. And I'm learning, especially with that team, the fan base is really integral, like it is for all of our teams, but in a little bit of a different way over there. And we've demonstrated, again, a lot of success, and we're always trying to think of ways to keep that going, whether it be with players or data or nutrition. It's those micro advantages in sports, in any of these sports teams that we own, that really can be what really makes the difference between a mediocre team and a championship team.
Paul, I know with your experience as an analyst, you're really focused when it comes to those media contracts on when it comes to local and national, right?
Yeah, absolutely. I mean, I think one of the big issues, actually, one of the things that's interesting, Julie, I mean, I'm just looking at the assets you guys do have here. Is there room for growth in other sports? Would you think about the NBA or maybe take a huge leap and think about the NFL? Is there other sports that you guys are looking at?
I think we're definitely in growth mode. We did only pretty recently acquire the majority of the Pittsburgh Penguins. So we're still, onboarding and bringing them into the family, although it's been a nice transition, I think, for everyone involved there. So, our aspirations are limitless, whether it be a major league such as those that you described or something new and different like Tomorrow Golf League. We recently announced that we are owners of the second team in that initially 6-team league. So we've got the Boston New England team in our FSG family as that league is getting started and building out, and that's a really exciting opportunity too. So they're not all going to be those large scale opportunities, but hopefully in time we'll continue to grow in bigger ways as well.
All right, so for all the Red Sox fans out there, the Red Sox are tied, I believe, with the Yankees as of today for last place in the American League East. It is the most competitive division in all of Major League Baseball.
Absolutely.
What do you guys do here? It's mid-July. What do you guys do here as you come up to the trade deadline? How aggressive is the Red Sox going to be? Are they going to be buyers or sellers here?
Question of the morning. I can't share a whole lot there, but I will say there's a lot of excitement around how the team's been performing, especially as of late. And I think the second half of the season, time will tell, but I hold a lot of optimism for the Red Sox.
All right, so Fenway, real quick, 30 seconds. I love Fenway. It's iconic. Everybody loves Fenway. Any changes coming to Fenway?
There's always something going on, whether it be a new, I think we had pickleball here recently. There's concerts coming up. Some things like that are new, but also we recently received some key approvals for some real estate expansion around the park. So we're partnering with WS Development here in Boston to, over time, add about 2 million square feet of mixed use to really just continue to elevate Fenway Park, make it even more welcoming to more people and very focused on pedestrians. And we're really excited that project seems to be moving along.
Great. Julie Swinehart, thanks so much for joining us. Julie Swinehart, CFO and Executive Vice President for the Fenway Sports Group's, the dreaded Red Sox. This is Bloomberg. Let's get some company news right now with Steve Rappaport.
Paul, UK antitrust regulators met with Microsoft officials today to iron out kinks for its proposed merger with Activision Blizzard to go forward, Bloomberg's Alex Webb reports.
It looks as though they might find some sort of agreement which will let the deal still complete tomorrow. Worst case scenario is that the whole process has to start again. It's unclear then how that would all pan out, given that the deal might well close. One caveat to all this, Meta's acquisition of Giphy, the GIF website or app, that closed, and then the UK blocked it after the fact. Facebook did end up selling Giphy.
Thanks, Alex. Shares of Microsoft and Activision both higher this hour. United Airlines stock get a boost today after the carrier and its pilots reached a deal on a new contract. More from Bloomberg's Jeff Bellinger.
Steve, it took more than 4 years of negotiations to craft a new labor agreement that is the richest ever for a U.S. carrier. The Airline Pilots Association says the deal, valued at about $10 billion, provides a cumulative pay raise of as much as 40.2%. The agreement also contains improvements to areas such as job security, retirement, and benefits. The new 4-year deal will help ease pressure on United, which has recently come under criticism after a series of delays and cancellations, even as the airline experiences soaring demand. Steve?
Thanks, Jeff. And Eli Lilly says it applied for full FDA approval of its Alzheimer's disease drug. Eli Lilly's treatment would compete with Eisai Company's Leqembi, which won FDA approval on July 6th. And those are the company stories we're following this hour. I'm Steve Rappaport. This is Bloomberg.
You're listening to Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
All right, Jess Benton, Paul Sweeney here in the Bloomberg Interactive Broker Studio. Getting a quick look at these markets here. S&P 500 up 0.3%, a little bit more juice in the NASDAQ. It's up about 0.7%. But the play here today is small cappers. Russell 2000 up 1.2%. We take note of that on the yield space, pulling in just a little bit. We've got the 10-year Treasury yield down about 2 basis points, 3.80 on your 10-year. Gold, it is steady, $1,955 an ounce. And oil, a little bit of a pullback after the nice move higher it's had over the last week to 10 days. It's now at off about 1.5% today, $74.33 on the Texas stuff. Right now, let's go to Denise Pellegrini for World and National News.
Paul, the cleanup is underway after more flooding in the Northeast. 5 people are dead after heavy rain turned roads into rivers in Bucks County outside Philadelphia. In New Jersey, the flooding triggered landslides over the weekend. It wiped out roads and bridges. A lot of damage there. Kelly Canfield in Belvedere, New Jersey, says her top concern is getting her family to safety. Her house is buried, Paul, under 6 to 8 feet of dirt. Listen to this.
We're just grabbing some stuff and going because what do you think's going to happen when they start moving this dirt that's holding back the rest of the mountain? That's my question. What do you think's going to happen? There's trees, they're still dangling. They could come down at any minute. So I don't know.
And further north in Connecticut, hundreds of acres of crops are underwater this hour. Governor Ned Lamont touring the damage in Glastonbury, saying this year Connecticut has dealt with a winter drought, a spring frost, toxic smoke from Canadian wildfires, and now historic flooding.
What the hell is going on here?
Yeah, so that's his reaction to that, Paul. We have seen the hottest June on record. Now July has 10 of the hottest days in history. Bloomberg's Amy Morris has the latest on the weather that we're seeing globally from Washington.
Simultaneous heat waves are stifling the U.S., much of Europe, and parts of Asia. El Nino is intensifying in the Pacific, while the Atlantic waters near Florida topped an unheard of 90 degrees. NOAA says 22 of the past 23 years were the hottest ever. Right now, 2023, 2020, and 2016 are all vying for the record. Climate scientists warn that the only way to stop this trend is for people to immediately and dramatically reduce their use of fossil fuels. In Washington, I'm Amy Morris, Bloomberg Radio.
All right. Thank you, Amy. Russia pulling the plug on Ukraine grain export agreement, says its terms haven't been met in nearly a year, and that heightens uncertainty over global food supplies. And Elton John backing Kevin Spacey and the Academy Award winner's sexual assault trial in the UK. Spacey himself has pled not guilty. Global News 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Denise Pellegrini, and this is Bloomberg. Paul, Jess, back over to you guys.
All right, Denise Pellegrini, thank you so much. We appreciate it. What the hell's going on here? And that's kind of I could ask that in a million different ways.
It's actually really true. Something, though, that you pointed out earlier is just looking at where the Russell 2000 is trading at today, outperforming larger counterparts. But if you go to the end of May, actually, RTY for the Russell 2000 up about 12% in that span, so outperforming the S&P 500 and the NASDAQ 100 in that span. The S&P's up about 8%, NASDAQ 100 up about 10%. But looking over at a recent note from Gina Martin-Adams and her team at Bloomberg Intelligence, they're saying if you're looking at the technicals for small caps, looks healthy, still trading above its 200-day moving average as well as its 50, and then still as long as it's above that 1900 level, that seems to be a bit of a near-term bullish sign for small caps.
I was going to say, and I think it's kind of a bullish sign for the market in general. You hear from a lot of market statisticians who like to see the breadth broadening out a little bit, so it's not just a handful of stocks driving this market. You want to see more participation. That's good for the overall health of the market and the move.
And the economy, when you think of the cyclical nature of that for small caps, and then also if you're looking under the hood for the industries with it, also cyclically oriented when you're looking at industrials and materials that are leading the way in that small cap index. And typically those are the ones that bottom before obviously large caps do. And we saw them hold up a lot better toward the end of last year and the beginning of this year compared to large caps.
Yeah, I mean, that's why it kind of comes back to a couple of our guests today, you know, they're kind of poo-pooing the soft landing. They think that we're going to get a little bit more of a harder landing. Anna Wong from Bloomberg Economics, who's really, really smart, so I generally take what she says. And we
she
also
knows.
had, RJ Gallo at Federated. He's not buying a soft landing thing. So, but I don't know. The consumer looks pretty solid. We'll get those retail sales numbers tomorrow. That'll give us a good read on the consumer. All right, Sound On with Joe Matthew. He's down in Washington, D.C. Sound On with Joe Matthew starts right now.
tropical places as well. Let's get to the biggest stories in the more than $10 trillion ETF industry. Investors are using a particular ETF to trade the special rebalance of the NASDAQ 100. We'll tell you which one it is.
And plus, pioneering quant investors, dimensional fund advisors looking to utilize a tax-busting design that has so far only been enjoyed by Vanguard. We're going to talk to the firm's co-CEO, Gerard Riley, in just a few minutes, Matt.
And as the heat waves and storms hit the U.S., we're going to drill down into one ETF that seeks carbon-neutral exposure to the electricity market.
And Matt, of course, with Eric stuck in Florida, supposedly. It's my turn to do Go with the Flow. Let's take a look at where money is moving in this industry right now. We'll start with the inflows. You're actually seeing some love for junk bonds up at the top. HYG taking in $2.1 billion in the week behind us. Big tech also seeing some love as well. The Q's taking in nearly $2 billion as well. And then you pair that with IVV, of course, that's broad S&P 500 exposure. Some cash going there as well, $1.3 billion. So that's where money is going. Let's take a look at the other side, the outflows from this industry. Up at the top, you have SPY, of course. This is so heavily used as a trading tool. It's hard to get a fundamental read on what $5.5 billion coming out of SPY means, but it's a chunk of change. Then you can see IWF, that is Russell 1000 growth, leaving some money exiting from that fund. And J&K, to pair with those HYG inflows, you are seeing outflows from J&K, almost $500,000 or so, or $500 million rather. But overall, if we zoom out from just the week to week, we know that ETFs have absolutely been crushing it. I wanted to compare this to the mutual fund flows, of course, in gold. You can see that mutual funds have been bleeding money for years now, and at the same time, ETFs for at least 10 straight years have beaten that. And actually, last year was a record rift to the tune of $1.5 trillion in this interesting market, if you can call it that we've had so far this year. The funds are a little lower in terms of the flows overall, but the message is clear, Matt, that ETFs taking in a lot more cash than their mutual fund cousins.
Yeah, and the trajectory looks the same. Katie, thanks very much. That brings us to one of the ETF industry's biggest stories. Quant giant Dimensional applied with the SEC last week to create ETF share classes of its mutual fund lineup. If approved, it would mean potentially big tax advantages for its mutual funds. Joining us to discuss is Gerard O'Reilly, the firm's co-CEO and CIO. Dimensional controls over $600 billion and is the largest issuer of actively managed ETFs. So we're very happy to have you on the show, Gerard. It's clear that if this is approved, it'll be a big win for mutual fund holders. Would it also benefit ETF holders?
Thanks for having me on the show, Matt. And the answer is yes. It would benefit, in our view, both mutual fund and ETF shareholders. And the reason behind that, Matt, again, in our view, is because we think the potential tax efficiencies that ETFs can bring to the table can benefit the mutual fund shareholders. And then mutual funds transact in kind. And the way the Dimensional transacts, we do a little bit of portfolio turnover each and every day. We do a little bit of rebalancing each and every day. And those cash flows can be used opportunistically to potentially benefit both mutual fund and ETF shareholders. So we think that this could be a win-win for both mutual fund and ETF shareholders if the SEC were indeed to grant this exemptive order.
If approved, you know, Katie was just showing the outflows from mutual funds, inflows into ETFs industry-wide. It's been a trend. Does that then turn around for you? And how does that, how do the tax advantages that ETFs have and mutual funds don't also change?
So if it were approved, our view is that it gives a kind of another tool, and this is the way that we view it, to money managers to help improve portfolios and make them even more efficient. What it might do to future flows, we don't really have a strong view on that. Our view is that for our clients, we like to provide the best-in-class mutual funds, best-in-class ETFs, best-in-class SMAs, and so we do whatever we can to improve the structures of each one of those vehicles through time. So I think that additional tool can be helpful for both mutual fund and ETF investors.
So let's talk about the SEC here, because as you and I chatted about last week, whether or not the SEC actually grants exemptive relief, there's no real deadline here. And we've seen others try and fail, such as Van Eck twice, I believe, in the last decade or so. So when you think about your chances here and the fact that the SEC doesn't necessarily have a deadline to respond, has the regulatory attitude changed at all in your view?
We've had conversations with the SEC staff on this topic previously, and our conversations, in my view, have been encouraging. Our arguments, I think, are compelling about why this can be helpful for investors, and in particular the investors in our mutual funds. So we look forward to continuing to engage with the SEC staff on this topic. When we might get a decision from the SEC, that remains to be seen. But we've had a lot of positive feedback over the course of the past week from other managers in the industry. So you may see more applications for exemptive relief going into the SEC, and that may indeed, raise its visibility with the SEC staff.
Well, Gerard, on that point, that if we see more asset managers come up to the line here, that it could raise the visibility. It seems like a lot of your strategy, your odds for approval, depend on other asset managers also applying for that. And to that idea, have you been in touch with some of your peers about applying for this, basically lobbying for this?
Well, I think that our odds for getting this approved depend on the merits of our arguments and the interaction that we will have with the staff, because exemptive relief is approved on a case-by-case basis, typically with the SEC. So our view is, let's get our arguments tight, let's get the conversations continued with the SEC staff and make sure they understand the benefits that we view could be accrued to the shareholders of our mutual funds if they were indeed to grant us this exemptive relief.
Do you have new products planned if this is approved, Gerard, or do you or would you make existing ETFs a share class of existing mutual funds?
Well, we always have new things in the works and are always listening to the financial professionals that we work with.
Specifically for this, in the case of this approval.
In the case of this approval, the step, if we were to get approval, the next step is talk to the financial professionals we work with, but also you need to get a fund board approval. So that would be a case by case. But there are many strategies that we have a mutual fund format, like in micro caps and so on, that we do not have a standalone ETF available as of yet. And so we would look across the range of strategies and work with our clients in the fund board to decide which would be most appropriate to have an ETF share class, if indeed this were to be approved by the SEC.
And Gerard, zooming out from just the topic of exemptive relief, if we take a look at Dimensional's lineup right now, you have 31 ETFs. As our intro said, you're the largest active ETF manager. Of those 31 ETFs, all 31 have seen year-to-date net inflows, which not a lot of issuers can say. Where are those inflows coming from? Are they organic, so to speak, or are they basically assets that are coming from other parts of Dimensional stable of funds?
After we launched ETFs back in 2020, what ETFs provided us is the ability to work with a broader range of financial professionals than we had done in the past, because there were many financial professionals that used mainly ETFs only. So it's really expanded our opportunity set to work with a broader range of clients, and a lot of those flows have come from new clients, whether they're independent financial advisors or clients that work at large broker-dealers or bank trusts. So a lot of kind of healthy flows into our ETFs, and you're right, about 16 billion more or less into our ETF lineup year to date.
And I do want to end where we started, which of course is on exemptive relief, because one of the reasons that a lot of people know Dimensional in the ETF industry is because you're very aggressive when it came to mutual fund to ETF conversions. I believe all told, you converted nearly 40 billion of your mutual fund assets into ETFs. If you were approved to issue ETF share classes of your mutual funds, would that effectively put an end to your conversion strategy?
Yeah, the funds that we targeted for conversion were tax managed or tax advantaged. And so 99+% of the assets in those funds were in taxable accounts. And that was the facts and circumstances with those funds. For the ETF share class, I think that it will be case by case. We have to work with financial professionals that we engage with. And some may prefer standalone ETFs, some may prefer ETF share class, some may prefer mutual funds. So it's too early to say yet, Katie, as to what we may do in the future with respect to conversions or offering ETF share classes, if indeed we got that approved by the SEC.
All right, Gerard, thanks so much for joining us. Glad we could get you to walk us through it. Gerard O'Reilly there of Dimensional Fund Advisors. Coming up, Cathie Wood fans have gone missing. Her suite of ETFs sees outflows despite posting impressive returns this year. We'll have those details next ahead of a couple of Cathie Wood interviews this afternoon. And last week, we had a chance to catch up with Mike Novogratz. He discussed the chances of a Bitcoin ETF being approved by the SEC.
If it happens, it's the seal of approval from the SEC and the U.S. government that this is an asset. And there is this giant infrastructure. Because remember, it's not just BlackRock. Like I said, Invesco is bigger in ETFs than BlackRock. And there are many players that are going to, and the SEC is not going to approve one. So you're going to have these giant sales forces out there giving access to people that didn't have access before.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, where mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is Deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. Time now for the ETF brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with an exodus from junk bond ETFs. If you look across asset classes so far this year, junk bond ETFs have lost nearly 10% of their total AUM. Again, of all the asset classes, what's done the best is your money market funds, those cash-like funds. Of course, we know that. And then you look down the list, equities are pretty much neutral. And then high yield ETFs not doing so great, even though on a performance basis, they are doing well. So not a lot of love despite that performance. It's a similar story if you take a look at Cathie Wood's ARC lineup of ETFs. As you can see, of the top 4 best performing ETFs in her lineup, they've all posted double-digit gains and then some, have not been met with love from investors, actually posting net outflows year to date for all of those top 4 performances. So flows have not followed performance for Cathie Wood. But let's also talk about the big tech stocks, because it feels like that's all we talk about nowadays, Matt. And there is an ETF angle here. Of course, NASDAQ is going to do a special rebalance of the NASDAQ 100 ETF to reduce the concentration. If you look at QQQE, which is a direction fund that's equal weight the NASDAQ 100,
Love it.
in anticipation of that, it saw one of its biggest inflows ever. I gotta say, I'm not quite sure what the play is here.
You know this about me, though, that I love equal-weighted indexes.
Yeah.
So I think it's very interesting. Also, I love rebalancing. Did you ever read Ugly Americans by Ben Metrick?
I've never read that.
People make fortunes on rebalancing if they get them right or if they have inside information. Let's talk about this right now with Isabel Lee, Bloomberg Cross Asset Reporter. So we've been thinking about this for a while now. You and John Authors wrote a great column about it. We're getting more information now, and then what? We see the actual rebalancing at the end of the week?
So yes, we don't like inside information, but we like analysis. So people are trading the QQQE ahead of the rebalance, and the rebalance is interesting because, for instance, Goldman Sachs today said that it's really not going to change the over-concentration much because they're still going to be over-concentrated, which is why a lot of mutual fund managers have stayed away from these large, heavyweight stocks, which is why they underperformed by around 31%. But because of the rebalance, we're seeing record inflows in QQQE, around 300 million in the last week, and it pushed up the assets to 1.1, which is a record, billion.
So what's the thought process there? If they're going to rebalance the tech benchmark, the NASDAQ 100, to be less concentrated on the Magnificent Seven, I believe we're calling them.
Magnificent Seven, Super Seven.
Yeah, so what's the thought process behind these inflows that we're seeing into QQQE?
I think it's a way to hedge bets because you don't know which are going to be the biggest gainers or the biggest losers. According to Goldman's estimates, NVIDIA and Microsoft are going to see the largest slice, and Apple is going back to its glory days. It's going to be the heaviest heaviest weight. But that's according to one estimate. So the way to hedge your bets is just to go equal weight, because without the top 7, Magnificent 7, Super 7, the NASDAQ equal weight isn't that high up. It's around 24% compared to the 50 plus NASDAQ.
So, but what's D-Day and what kind of volume can we expect on that trading session?
D-Day is July 24th, so that's next Friday. So it's the only day I'm going to be looking forward to from this moment on.
It's my husband's birthday, July 4th.
Oh my gosh, Joe's birthday.
Happy birthday, Joe.
Yeah.
But it's going to be a massive day of volume in markets, right? And nothing to do with Joe. People are going to be trading in and out of this, trying to get their indexes, their trackers to exactly match the newly rebalanced NASDAQ 100.
That is true, especially for QQQ, which is the second biggest ETF or heavily traded ETF, because it's going to have to rebalance as well because it heavily tracks the NASDAQ. So people are going to be closely watching that, as well as QQQE and other tech heavyweights and communications heavyweight ETFs. So it's going to be an exciting day. And it's also going to be Joe's birthday.
All right, we got a lot to look forward to. We have to leave it there, though. Bloomberg's Isabel Lee, thank you so much.
Still ahead, we're going to have an electric drill down with CNIC CEO Tim Cramer on the first commodity-based carbon-neutral ETF. This is ETF IQ on Bloomberg.
Okay, so you're moving in on me quick, distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. You got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg ETF IQ. I'm Matt Miller, along with Katie Greifeld. Katie, you have our drill down for today. Since Eric is
stuck in Florida. Since Eric's stuck in Florida, I'll pick up the slack here. Today's drill down, we're focusing on AMPD. You take a look at this fund. It's the CNIC ICE U.S. Carbon Neutral Power Futures ETF. First of its kind since it tracks electricity futures. It only launched back in May, so barely 2 months old. It's taken in about $5 million in assets so far. And to do this, it charges 95 basis points. Let's take a look at the holdings, since that's the really interesting part of this fund. It basically tracks electricity futures from 6 regional power pools in the U.S. It's weighted by its average annual load as measured by megawatt hours. I learned a lot while I was researching this ETF. It also holds carbon allowance futures to basically offset the emissions generated by those electricity contracts. So really interesting mix of holdings here. If you take a look at performance, again, it's only about 2 months old, so there's not too much to look at here. Since inception, on a total return basis, it's off by 2.3%. But as you can see, since mid-June, and since all we talk about now is how hot it is, you can see that the performance has been trending more positive, Matt.
Yeah, very interesting and timely ETF. Joining us to talk about this fund is Tim Kramer. He is the CEO of CNIC Funds, the company partnering with ICE for the product. Tim, thanks so much for coming in. Talk to us about, the timeliness of this release, I think. Just as we get horrible weather or, incredibly hot days, it started to pick up some attraction to investors.
Right. So what happens is the whole thesis of this is the electrification of America. And so electricity is the most consumed commodity in the U.S. on a retail notional basis, but it's not in any ETF, any index, nothing until now. So we constructed this the way that you guys have described it. And of course, when we launched it, it was right on the heels of like a very mild winter. So it went down, as you say. But now that you've got this heat coming in, the fundamentals are kicking back up, and you're seeing this index start to reflect that.
So as we use more and more electricity, and of course the heat means more people are using air conditioners, it's very worrying for a lot of the grids across the country. Do you expect it to attract more retail dollars?
Yeah, absolutely. So first of all, we think just on an absolute basis, electricity is about 2.5% of CPI. So if nothing else, the investor should just take a look at that and say, okay, that's kind of what I'd like to put the money in and have it be sticky money. But then if you want to take a look at relevant commodities, like we said, this is the most used commodity in the U.S. And so you've got Bloomberg Commodity Index, other commodity indexes, but if you don't have the most relevant commodity in there, you might want to reconsider that. So we think that at this point in time, the weather and these other elements are giving us, some added tailwinds, but we still think it's something that should be in a portfolio for the long term.
Well, you bring up other commodity ETFs, and that's what I find so interesting about this ETF is because for other commodities, you have specific ETFs. You have oil ETFs, you have gold ETFs, you even have wheat ETFs, for example. How big do you think the potential market is here for electricity? So if you take a look at the top 25 pensions and the top 25 endowments in the U.S., so the top 25 U.S. pensions have about 2.5% allocated to commodities. The endowments are about 3%. So if they took a look at those numbers just based upon what they'd want to do for inflation protection or for their commodity allocation, we think this could be very big. The Bloomberg Commodity Index and the associated ones like the Goldman Sachs Commodity Index, they've got
about anywhere between $800 billion to $1 trillion allocated to them. And so we think the open interest on the ICE future supports several billion dollars in this without actually denting the liquidity.
Well, to that point that you bring up pension funds, for example, is that your targeted audience? Who do you see as the ideal investor in a product like this?
So the pensions and endowments have been interested in this, again, for the portfolio diversification, because this is literally correlated to nothing. And then also for the inflation protection. And for just their regular commodity holdings, they want to have the most important. And then if you take a look at the high net worth or the family offices, they tend to have a higher allocation to alternatives and or commodities, and so they've been interested in what this looks like. And then if you just take a look at model portfolios, so instead of the old 60-35-5 model, if you were 60% equity, 35% debt, and for the 5% commods, if you did, we'll say 3% in a traditional index and 2% in this, that would be an interesting allocation.
Katie mentioned when looking at the breakdown of the fund that you put carbon credits in there.
Right.
How does that work out? How do you do the math for those?
Sure. So what happens is each one of the individual power pools where the electricity futures are, they will give you publicly available data to tell you what the carbon footprint is for each one of those areas. And then we use exchange-traded electricity futures, and then we use exchange-traded carbon offsets. The EPA gives you data for that. So it's all publicly available data, so it's not somebody doing, black box or something in a vacuum.
And we only have about 45 seconds left with you, but what's next? Now that you have AMPD off the ground, what else are you setting your sights on?
So we've had a lot of interesting inbounds with respect to taking this particular index and ETF and combining it with some of the other ones that are out there and making a hybrid product so that you could take some of the allocation and some of the math out of the hands of the investor and take care of that for them.
All right, very cool ticker also.
All the other ones like Volt and Shock were taken.
Well, Amped is way better. I like it much better for that exact reason.
Yeah.
Tim, thanks so much for coming in. Great
Appreciate your time.
to talk about this product. Thanks to CNIC CEO Tim Kramer. And if you just can't get enough of ETFs, remember that you can listen to Eric and Joel Weber on Trillions. That's their bi-weekly podcast that covers the industry.
And that does it for Bloomberg ETF IQ. Matt, this was fun. Even without Eric, I think we had an okay time.
Yeah, we could do it without him, but we still want him to come back.
Yeah, well, he'll be back next week, of course, on Monday. I'm Katie Greifeld, along with Matt Miller, and this is Bloomberg.
Politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Limes.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come. I'm willing to have this battle.
It is vitally important. This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. but we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union, and then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine, and we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Canwar in for John Ehrlichman. Welcome to Bloomberg Markets.
And I'm Matt Miller. Let's get a quick check on what's going on in the markets at this hour. We are seeing some gains on the S&P 500, just about 0.25%, a little bit more than that, to 45.18. So still we're at the highest levels that we have been in over a year. Take a look at the 10-year yield right now, 3.8087, coming down about 2.5 basis points as investors buy those bonds as well as stocks. They're not buying the Bloomberg dollar index is unchanged right now, but last week we saw it snap a 5-day winning streak, and it's lost some serious ground. NYMEX crude is also down just about $1.30, but still holding at about 75 a barrel, $74.12. We're seeing more supply come on from Libya, for example, and that's weighing on crude across the globe. Amber, what are you looking at?
I'm taking a look at those telcos. They continue to trade lower. Check out shares of AT&T. This is the lowest level we've seen for the stock in 30 years. Verizon is hitting a 12-year low. There continues to be concern about what their liability is for some of those cables that they laid about a decade ago, more than a decade ago, that could contain lead. You saw a number of downgrades, particularly on AT&T. AT&T is trading at 5 times earnings, got an 8% dividend yield, but clearly no one is willing to step in front of this one at this point. On the flip side, I'm tracking the financials in the United States, the S&P 500. The financials broadly as a group are higher as we're in kind of that quiet zone. We got big earnings Friday. We've got more of them this week. Most of them are trading up except for State Street. State Street on Friday warning they're going to take a hit to their net interest income, and we've counted at least 3 downgrades on the stock, so no recommendation that you buy on the dips, Matt.
All right, very interesting stuff and fascinating to watch AT&T today as well. Let's dig in, though, to the regional banking industry, many of which report second quarter earnings this week. Rebecca Romero Rainey is president and CEO of Independent Community Bankers of America. Rebecca, I want to ask first if we're out of the woods yet in regards to assets that don't get marked to market being worth a lot less than they are on the balance sheet. How do you see regional banks across the U.S.?
Well, Matt, I have the opportunity to represent independent community banks across the United States who have a long history of managing through varying economic cycles. And so as I look at where we are today and we look at what's to come as we look at future Fed fund movement, community banks are well positioned to continue to manage that balance sheet risk and continue forward with a very strong posture to serve communities across the United States.
So as the Fed continues to raise rates, and we do expect them to do it again at the end of this month, you're not worried about duration mismatches, the likes of which we saw at a few of the failing banks back in March?
No, when I look at the community bank balance sheet, those balance sheets are structured to manage these risks over time and to take into account future upward rate movements, knowing that the decisions that they're making on those balance sheets are for the longer term, very different to the balance sheets that we saw in the failures a few months ago. It's interesting that you say they're well positioned because a lot would say that they're challenged on a number of fronts, either their exposure to commercial real estate, their expensive deposit base, as well as just a general lack of diversification without, capital markets or wealth to lead on. Where is the source of resiliency coming from?
The source of the resiliency is based on a long-term approach to that balance sheet management. Let's take CRA, for example. Majority of your community banks are banking and lending on properties that are owner-occupied that continue to show very strong performance. And that's playing out in the numbers. When you look at past due or non-current loans in the community banking balance sheet, almost historical lows that we continue to see. And again, it comes from this perspective that those managers of community banks are making decisions not for the short-term return, but over the long term and for a duration that really allows them to create a stable balance sheet that manages some of these challenging times.
Are you worried about more regulation, Rebecca? Are you worried about more compliance costs for the banks that you represent?
I do. When you look at regulatory burden and what that does to just essentially increase the cost of doing business, as community banks make 60% of all small business loans, 80% of agricultural loans, they're a vital source of and supplier of capital for small businesses and entrepreneurs across this country. And an increased cost of compliance and regulatory burden as sort of a response to what's happened in a couple institutions does not help them serve those communities any better.
Do you think then that the chaotic period we saw of bank failures and consolidation is a thing of the past, or even though the sector as a whole is resilient, we still might see consolidation problem spots emerge?
I think what we saw a few months ago really was truly an extraordinary situation as we look at what was going on in those individual banks. That's very different from what we see across the financial services sector. And so while we are still managing through whether it's this interest rate environment or whatever the economic challenges may be, I think that we really are coming from a position of strength in the community banking industry. And that's what we have to remember as we think about these balance sheets that are built to manage challenges over time.
So you don't think we're going to see a big wave of consolidation? I mean, a lot of the smaller community banks are going to be, it's going to be difficult for them to pay like 5%, right, on deposits. People are going to move money out left and right as they see those offers from other banks. Does it make sense to put some of them together?
Absolutely not, because as you put some of those banks together, it's not here about solving for scale. It's about ensuring access to credit. It's about ensuring that local communities have local financial institutions within their market. And so, again, I think about the time that we're in is just another point in the cycle. We've been here before. Community banks have managed through challenging times. Yes, there's challenges as we think about the cost of deposits and the cost of funds that has risen significantly, but community banks are figuring that out. They're continuing to lend in their communities and, again, are that source of strength.
Where are they looking to then for innovation? Is this a sector that is taking a hard look at artificial intelligence, and to what degree?
We're a sector that's looking at innovation from every angle. It's about, one of the things I love about community banking is we bring a high level of service with a high tech approach to what we do. And so it's looking at innovation, whether it's in the front customer facing application, is in the back room and the operation, continuing to find scale and efficiencies. And I think given the small, nimble size and structure of community banks, they're really well positioned to leverage some of the innovation that we have available to us today.
All right, Rebecca, thanks so much for joining us. Rebecca Romero Rainey, she is president and CEO of Independent Community Bankers of America. Now, one person with her eye on the banks and the U.S. economy is the U.S. Treasury Secretary, of course, Janet Yellen. She is currently at the G20 finance ministers meeting in India. She spoke in an exclusive interview with Bloomberg's Anne-Marie Horder earlier about recession risks.
For the
United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging, that we're making progress on getting inflation down. But as I'd hoped and expected, that would occur in the context of a strong labor market, and we continue to see that. The fact the labor market's been so strong has encouraged more prime-age people to enter the labor force and to work, and that's helped take a bit of the heat out of the labor market. The fact that growth overall has slowed after we enjoyed a rapid recovery, that's normal, but it's also led to some reduction in the desire of firms to hire. Still lots of job openings, but wage growth is moderating and inflation is subsiding. So I think we're in a good path on the United States.
That was U.S. Treasury Secretary Janet Yellen speaking exclusively to Anne-Marie Horton from the G20 finance ministers meeting in India. Coming up, Ford slashing prices on its electric version of the F-150. This is the truck that saw prices raised like 50% at the bottom of the barrel. So they're going back around again and cutting them. Ford is our stock of the hour next. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg Markets. I'm Amber Canwar with Matt Miller. Time now for Stock of the Hour. Ford is slashing prices on the electric version of its best-selling F-150 pickup by as much as 17%. Matt, shares are falling on the news, which brings the truck prices to below the $50,000 threshold.
Yeah, shares down, right? Because people are concerned that they don't have the kind of pricing power they have had with this truck when it was the only one in the market. Keith Naughton is our expert on the Ford Motor Company. He's been covering the news for us this morning. He joins us out of Detroit. So, Keith, very interesting move for Ford, considering the prices on these vehicles had gone up by so much, and now it looks like they're going to start to come down.
That's absolutely right, Matt. They drove the prices up on this vehicle 50% since it launched in April of 2020. It was up to starting at $60,000. Now they've pared that back by 10 grand, and it now starts at $50,000 for the Pro version, which is the contractor's version. The one that consumers would buy, the XLT, now starts at $55,000.
Is the concern when we're taking a look at the stock reaction that Ford, even though they increased prices and this is still higher than the original price with these cuts, they don't necessarily have the margin space that like a Tesla does?
Yeah, well, Ford plans or says it expects to lose $3 billion on its EV business this year, but they want to reach an 8% EBIT margin by the end of 2026. So yeah, investors are worried that this gets in the way of getting to that tall walk to that EBIT margin by the end of 2026. But they also need to get volume to get there. And the way you get volume is you price your product in an affordable fashion.
You know, what's interesting to me, Keith, is we always say, the F-Series is the best-selling pickup truck in America, but that goes across the gamut from the F-150 to the F-750, right? And I've always wondered how it would do if Chevy and GMC and Cadillac all had their pickup trucks on the same platform. I mean, they do have the same platform, but the same kind of commercial model. We're going to finally see that battle in the EVs, aren't we? Because the Silverado is going to go up against the F-150.
Yeah, Silverado's coming. It's already here, actually. They started producing it in the spring. The consumer version is now in production. So Silverado has arrived. Next year, there will be an electric Ram that's scheduled to go into production called the Revolution. We have the Cybertruck now finally coming online 4 years after introduction. The Rivian truck is already out there. So competition is really heating up in this electric pickup space. And that's why you're going to see more discounting, more price cutting.
This is coming as Tesla's Cybertruck has come off of the production line. How proven is the demand for electric vehicles of this kind of car? Because in some ways, these are kind of the last holdouts, I guess, for those interested in electric vehicles.
Yeah, it's a big vehicle to power by electricity, and it takes a huge battery, which is what drives the cost up. But the F-150 Lightning, the electric version of the F-150, has proven very popular. Ford is expanding capacity at the plant. They're tripling production. They're going to be building 150,000 of them a year. So there's definitely demand for electric pickup trucks. People like them. They like the acceleration. They like the clean footprint. But it will get to be much more of a pitched battle like the gas versions of pickup trucks once everybody's in the market.
I like the frunk on this vehicle. By the way, Keith, I know they've shut production at the Rouge to kind of retool a little bit so they can make a lot more of these in Detroit, but they have a factory that they broke ground on in Tennessee, and they're going to build kind of the next generation of electric pickup trucks and three-row SUVs. What do we know about the products coming from Ford?
Yeah, that factory, which is the first brand new factory Ford has built in more than half a century, will be massive. It'll be capable of producing 500,000 electric pickup trucks a year. So they're clearly expecting a lot of demand. That next pickup will be fully connected, fully digital. The one they have out right now, the Lightning that's out right now, is basically a conversion of the gasoline version of the pickup. They put a battery beneath it and added a lot of cool features, but it is a conversion of an existing truck. The next one will be all new.
All right, Keith, very much looking forward to seeing that, and of course we'll be interviewing you when it comes out. Keith Naughton covers the Ford Motor Company for us out of Motown, Detroit, Michigan. Coming up, some billionaires are trying to make the world's second most popular sport, which you might not even have heard of, cricket, popular in the U.S. We're going to talk about their chances of success and how they're doing so far. This is Bloomberg.
So Fabian, talk to me a little bit about the ocean. It covers 70% of the planet. It gives us food. It gives us jobs. It gives us, of course, oxygen. We're taking too many fish out. We're polluting it. We're making it warmer. And only 3% of it is protected. What frustrates you the most about this?
The basic frustration is our ignorance. Our ignorance about how integral ocean is to not only our well-being, but to our existence. And for far too long, we've been using the ocean as an endless resource in a garbage can. Imagine our planet is a three-dimensional system. The ocean represents 99% of our world's living space, about 3.4 billion cubic kilometers of volume, within which the vast majority of biodiversity lives and thrives. And that's what we're beholden to. That is what makes us possible as a species.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome to Bloomberg Markets. China open.
This is Bloomberg Technology.
To our television and radio audiences worldwide, welcome now to Balance of Power. This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Markets. I'm Matt Miller with Amber Kanwar. Cricket is the second most popular sport in the world. It's played by 3.5 billion people globally, and it's been steadily growing in popularity in the U.S. for years. Billionaires from Satya Nadella to Ross Perot Jr. are backing a league in the U.S., and Anurag Jain is the co-founder and managing partner of Perot Jain, a venture capital firm that he co-founded with Perot Jr., and they have a stake in one of the big teams that we're hoping to watch more of this year. Anurag, thanks so much for joining us here on Bloomberg and BNN. Tell us about your team, the Super Kings, and how this all came about.
Great. Hey, Amber and Matt, first of all, thank you for having me on. I'm going to go back and tell you a story. So I grew up 35 years ago in Chennai, 7,000 miles away from here. And I grew up playing cricket. I grew up playing street cricket. And by the way, for a couple of years, I was pretty good. But, you know, in those days, cricketers made 10 cents a day. And my dad sat down with me and said, you know, son, your cricketing days are done. You need to get on with it. So that little seed was in my brain. And, you know, I watched cricket grow. I watched this league grow. I watched these teams grow. But then I wanted to bring it back to the U.S. I'm super excited that at this point in time, we're able to bring it back with a joint venture with my favorite team, the Chennai Super Kings, right here in Dallas, Texas.
Very cool. So you have gotten the chance to bring it back with, as we said, Ross Perot Jr., your partner in business. And there are some other people, Satya Nadella, for example, Shah Rukh Khan, who are also excited to bring cricket to the U.S. We've seen some real success with soccer. Do you think you're going to be able to get the same kind of trajectory that they have had?
That's a great question. So let's go back, right? So soccer started in 1992 when people didn't know what soccer was. It took 30 years to get here. Now go to cricket today. Today, without having a local league, we have almost 7 million followers. And cricket falls in the top 4 or 5 in terms of just volume of people that watch it and the cash that they generate off the media rights in the U.S. alone. So if you look at that market today, the number of people that are here, the South Asian population, the popularity of cricket is growing. And of course, we're talking about T20 cricket, which is a 3-hour game, something Americans don't know. It's a simple, fast 3-hour game. Just given the global popularity and what we're seeing in the U.S., we think it's a great bet.
Anurag, in Canada, we have a whole channel dedicated to broadcasting NHL games in Punjabi, and it is a huge success because there is a huge Indian population in Canada. Is what you're trying to do in the U.S. kind of a play on immigration and selling a product to people who are interested in it because they're from another place, or is it trying to get, Americans who are second, third generation interested in a sport they may have never heard of?
Amber, that's a great question. I think we have a built-in population with the population growth of the immigrants, especially the South Asian immigrants, but that's simply a springboard. We really need to make it work for all of us, for all of the Americans. Now, soccer took 30 years to become a household name, and we're patient. But, we have to make investments in the kids playing cricket. So yesterday in my suite, we had a bunch of kids that had never seen cricket before, and they're super excited about the constant action that they saw. Our future is really treating the American people to a new sport, getting the kids excited in it, them growing up with cricket, and then becoming a household name just like soccer has.
Okay, what about pickleball? This has become the fastest growing sport in the U.S. You already have cricket with this long history, but for some people, it might be just as fresh as pickleball is. Is there anything from their playbook that you're going to look to, copy?
We're like a startup, right? So we're like a San Francisco, Silicon Valley startup. We're looking at all of the success stories and some of the lessons. We spent a lot of time with the MLS founders, and we did a bunch of things that they said they would do differently. Most important one of those is quality of product. So we're putting in great infrastructure, getting the top players in the world to come here and play. And what the fans are seeing is an amazing quality product. That, we're told, is the most important thing to get anything going. Pickleball, rugby, or cricket. So all of that is working. And we're looking at all of the leagues around the world, successes and failures, and hopefully, we'll make our own mistakes, but hopefully we'll learn from their successes and replicate some of them.
It's Bloomberg, so I got to ask the money question, Anurag. You announced a $120 million raise a few months ago. Are you already in the process of raising more money for an expansion?
Look, there's a lot of infrastructure required, and we're bringing the top players in the world over here. We've put a lot of money into the league, and for some period of time, we'll need to put more money because this is the highest quality product, and the fans will catch up over a period of time, and we'll need to invest more money.
All right, very interesting, and we will be watching, at least I will be watching for sure. It's a very exciting development. Anurag Jain there of Pro Jain talking about the foundation, really, of what they hope to be a new popular sport in America, and his team, the Super Kings. All right, for Amber Kanwar, I'm Matt Miller. We'll continue to watch markets rally in terms of bonds and equities, and we'll keep you up to date throughout the day. This is Bloomberg.
We're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Modest gains on this mid-Monday afternoon, live from Studio 2 at Bloomberg World Headquarters. Romaine Bostic here.
And I'm Katie Greifeld. We're kicking you off to the closing
bell. You are indeed.
I am. I saw it in the prompter. I kept running. Let's talk about what this market is doing right now, because we're officially in a holding pattern ahead of next week's Fed report. Of course, we're in that blackout period. You can see we're seeing modest gains at the S&P 500, up about 0.4% on pretty healthy volume. You take a look at big tech, off to the races here, up about 0.8% once again in charge. Then you take a look over at the bond market. Things are much quieter. You're looking at a 3 basis points dip or so in the 10-year Treasury yield. We're looking at 380 here. It's going to be really interesting to chart these moves, of course, as we get closer to that July Fed meeting. And I also wanted to focus on the dollar versus the offshore yuan. Of course, one of the big stories overnight, Romaine, was that disappointing GDP data for the second quarter out of China. You can see the dollar strengthening against its Chinese counterpart.
Yeah, that's right, Katie. Let's start there. A big miss on China GDP. In fact, when you broaden it out, look under the hood here, you had that slowdown in retail sales growth at 3.1%, down from a 12.7% pace back in May. You combine that with the youth unemployment rate climbing to 21% and investment in property development falling about 8% in the first 6 months, prompting a lot of concerns by Wall Street economists out there, cutting their outlooks here for China's growth. The benchmark index over there falling for the first day in 3 sessions. The onshore yuan weakening by about 0.5%, and base metals like copper sliding the most in almost 2 months. Now, the negative reaction reflective of market expectations for what was supposed to be sustained consumption and a service-led recovery out of China this year. We had a chance to catch up with the U.S. Treasury Secretary Janet Yellen earlier today, who says she too is concerned about China's economic slowdown causing ripple effects across the economy. Take a listen.
Slow growth in China can have some negative spillovers. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession.
Yeah, and of course, Yellen there saying she is concerned about the ripple effects from China, but not enough to think that it's actually going to cause a U.S. recession. Katie Greifeld, the economic resiliency here in the U.S. has been a big part of the market story all year long.
And you can see that if you take a look at the stock market. The S&P 500, it's reclaimed 4,500 on the S&P 500. Hopefully we can show that chart pretty soon. A lot of those gains really came after a really robust first half, which of course sets the bar up pretty high for the second half. And so far gains have been pretty tepid, even though we have been holding around that 4,500 level. But of course, this is heading into earnings season, which is going to be a very crucial test, of course. We've seen that those profit estimates for S&P 500 firms have been outpacing the upgrades. The downgrades outpacing the upgrades. S&P 500 profits expected to drop about 9% this quarter, Romaine. That would be the worst performance since 2020.
All right, let's get right to our first guest here, Katie. Jason Trenner joining us, Chief Investment Strategist over at Strategas, as we kick you off to the closing bells here on this Monday afternoon. And Jason, earnings season began in earnest last week. You had, of course, a couple of the big banks. You had some airlines report as well. And I know it's still early, but what are your expectations this time around?
Well, listen, corporate profits peaked 2 quarters ago for the S&P 500. They peaked 3 quarters ago if you look at the GDP accounts, the NIPA accounts. And so I would suspect that earnings are still going to be under pressure, and that's mainly because when you look at GDP growth, you have more inflation than you have real growth. And that puts a lot of pressure on productivity and corporate profits. As we said before, there are estimates somewhere between down 7 and down 9 for the quarter. We know it'll be better than that. They almost always beat. But it does look like you're probably going to have the 3rd quarter in a row of a decline in corporate profits for the S&P.
Well, when we talk about that decline, obviously we're talking in aggregate here, and there's been a lot of discussion about kind of a rolling recession, both in terms of economic as well as earnings recession as well here. Is there sort of any space that you find in the equity market right now, sectors that maybe will hold up better?
Well, certainly if you look, and of course this started with the Magnificent Seven, and now it's broadened out to probably the top 50 companies. But the companies that are most at risk, obviously, are the companies, which is most companies, which are dependent upon the kindness of strangers to give them capital. Right. But if you look at the Magnificent Seven, those companies generate so much cash that I don't want to say they're immune from higher interest rates, but they actually benefit from higher interest rates to the extent to which they have a lot of cash and don't have to issue debt, and they generate a lot of cash flow. That isn't most companies, though. Most companies have to issue debt. They have debt. They have to issue capital in the equity markets, and so that's why I think you're seeing this bifurcated market. Those companies I think should continue to do pretty well. I wouldn't short them, even though the valuations are quite high. But I do think some of the more cyclical sectors are eventually this inversion of the yield curve and higher interest rates is going to catch up with them.
Well, what signal do you take away from that inversion of the yield curve, which has been going on for over a year at this point, very persistent in its inversion? Do you take that necessarily as a recession signal, or is it telling you something else at this point?
Well, it depends on which curve you're using. The New York Fed has, they have a New York Fed probability of recession index, which is a curve of the 3-month versus the 10-year bill, and 3-month bill versus 10-year note. And what's remarkable about that series is that it's almost 100%. And it's been inverted now, as you said, for a better part of a year. And there hasn't been a period, I think, back to the 60s where it hasn't resulted eventually in a recession. I would also say the level of interest rates is important. And it's one thing being inverted when interest rates are a lot lower. When interest rates are quite a bit higher, you get short rates at 5%, you have a prime rate at 8. I think it makes a bigger difference. And so that would be the only, maybe trying to get too cute with it, but I do think that is a meaningful difference from an inversion last year. It's just the level of rates is higher.
Well, that's what I'm trying to square here. If, the curve is inverted with the short rate at 5%, is that less scary than when there's an inversion and rates are low? I don't particularly think so. I think it's kind of worse this way because you actually have to come up with the money, right? And especially last year, you actually benefited in a certain way by inflation being a bit higher. So profits were inflated in nominal terms, so you could pay off the debts a little bit more cheaply. Believe it or not, now that inflation's coming down and you have somewhat higher debts, it becomes a little bit harder. But listen, I think, generally speaking, stock prices are a function of cash flows and interest rates. And I think those cash flows are slowing down, and I think rates are still relatively high.
You mentioned inflation coming down. Are you a believer that trend is going to stick? There's still some fear that we could see a re-acceleration.
Yeah, I certainly look at the core numbers and see that they are still sticky. And I think a lot of the easy parts of getting inflation down are probably over. And not that, and the Fed should be given a lot of credit from getting inflation down from 9 to 3 on the headline number. But I think if they're dead set on getting 2, which I'm not so sure they are, I think that would be very painful. My own expectation is if they can keep it at 3 for another, painful. My own expectation is if they can keep it at 3 for another. Itself, if you're looking at trailing, is probably about 20 times trailing and maybe 18.5, which I think are forward, which I think the earnings are pretty optimistic for next year, so it might be a little bit higher than that. It's hard to square those numbers with, let's say, a steady state of 3% inflation. Generally speaking, that would be more consistent with a 17 multiple. So it's hard. I would just say that from a risk-reward basis, it's hard to get really excited about stocks at these levels. And having said that, I recognize that they keep going up, right? So I mean, it is very possible. It wouldn't be the first time that I'm missing something. But I don't think, again, the risk reward is particularly attractive right now.
Well, then let's go cross asset here because, of course, I believe you invented the phrase, Tina, there is no alternative. So if you can't get excited necessarily about stocks here, when you look across the landscape, what does get you excited?
Well, listen, I think my own particular feeling is buying a 2-year Treasury note at 5. If I'm looking forward over the next several years, 5% I believe is going to be a pretty good return, and that's mainly because I think it's going to be hard to get multiple expansion from here in the equity markets. It's going to be hard to get a big acceleration in corporate profits from here. So I don't want to say to go to cash, but I mean I think that is interesting to me. I also think that there are certain sectors, particularly I would put energy in that sector, where you're getting a lot of money just up front, just from the dividends and the shareholder return. So you're kind of paid to wait for that to work out. So that's another place where I would take a look.
All right, Jason, always great to talk to you and see you in person. Yeah. And by the way, you should put that Tina thing on your resume. It's going to do wonders for your career.
All right. Thanks a lot.
Jason Trenner over at Strategas helping us kick you off to the close here on this Monday afternoon. Coming up next, you're going to hear from that exclusive interview with Treasury Secretary Janet Yellen, her take on the U.S. economy, the odds of a recession, and where things stand in that fight against inflation, Katie.
Plus, United Airlines reaches an agreement in principle with its pilots union. We're going to have the latest on what's in the deal and the odds that it will eventually be ratified.
A lot of focus on ESG, a conversation coming up on our Wall Street Week Daily segment with Douglas Holtz-Eakin, president of the American Action Forum. He has a lot of thoughts here on some of the misinformation surrounding that sector. All that and more coming up in just a bit. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
The names that move markets are on Bloomberg.
Concentration in industry after industry after industry is a threat to our economy. It is a threat to innovation. And ultimately, ultimately often leads to price gouging, whether it's consumers or the government. I believe in the power of markets, but they only work if we enforce the rules that keep competitors going rather than monopolists.
Nobody covers business like Bloomberg, your global business authority. Season is here.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery. Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Janet Yellen, the Treasury Secretary of the United States, does not expect a recession in this country, even though she does cite some potential ripple effects felt globally from China's economic slowdown. She sat down exclusively with Anne-Marie Horton a little bit earlier. Let's take a listen.
For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think that we're on a good path to bringing inflation down. The most recent inflation data were quite encouraging, that we're making progress on getting inflation down. But as I'd hoped and expected, that would occur in the context of a strong labor market, and we continue to see that. The fact the labor market's been so strong has encouraged more prime-age people to enter the labor force and to work, and that's helped take a bit of the heat out of the labor market. The fact that growth overall has slowed after we enjoyed a rapid recovery, that's normal, but it's also led to some reduction in the desire of firms to hire. Still lots of job openings, but wage growth is moderating and inflation is subsiding. So I think we're in a good path on the United States.
Okay, so it sounds like soft landing is your base case, and you don't think we're going to see a recession. Yesterday, when you were speaking to reporters, you talked about this de-escalation with China, and you ruled out lifting tariffs as part of this de-escalation with Beijing. So what is on the table?
On tariffs, we put tariffs in place on China because we had underlying concerns about unfair trade practices, particularly those affecting intellectual property and technology transfer. And those concerns really have not been addressed. We're undergoing a 4-year required review of tariffs. And of course, China also retaliated, putting tariffs in place on us. We have to see what comes out of the 4-year review, but I would emphasize that really the underlying concerns we have not yet been addressed, and we need to work on that going forward.
And of course, that was U.S. Treasury Secretary Janet Yellen speaking exclusively with Bloomberg earlier. And for more on her forecast of a U.S. recession maybe not happening and the potential impact that China's economic slowdown will have on the U.S., let's bring in Victoria Dendrino joining us on set now. And it was interesting also hearing her comments on de-escalation with China, but at the same time, tariff reductions aren't on the table and that the U.S. is still, considering outbound investment curbs. So with those two actions, where is the de-escalation potentially coming from?
I think the Secretary is just trying to strike a more maybe moderate tone. She was just in Beijing last week, and she's just trying to say that, listen, like the U.S. is looking at its national security. It is taking actions where these are warranted, but we should not engage in this kind of war where every side escalates and we're hurting each other's economy. So I think she's waiting to see whether there's any movement from the Chinese side. Obviously, like you mentioned, the outbound investment executive order is in the works from the president's office in D.C., but
How much is she speaking, I guess, for herself and her own agency, and how much is she speaking, I guess, for the broader White House? Because there does seem to be some conflict between what is relatively encouraging rhetoric out of her, but that rhetoric doesn't necessarily match up with other members in the administration.
I think it depends a lot when you look at the kind of like underlying, both the agency, in this case the Treasury, but also whether we're talking about economic subjects or like military or foreign policy.
Yeah.
So on the economic side, there's definitely been a desire both from the White House and Treasury to open these channels with China and to, enhance cooperation with them and collaboration with them, because it's been pretty radio silent for the last few years. And I think, with regards to national security being a priority over economics potentially, there she is in line with the White House.
And let's talk about where else Janet Yellen is focusing her efforts right now, because I believe she was speaking on the sidelines of a G20 meeting. She's going to be visiting India. Where else is she stopping on this world tour, if you will?
Yeah, she's in India, like you said, in the G20. I mean, she's really interested in international global challenges like climate change, but also debt relief for poorer nations. So, for instance, she's been really pushing for the Zambia debt relief that happened last month. But she's also stopping in Vietnam, which is part of this U.S.-French shoring push where she talks about diversifying supply chains. That's obviously relevant to China as well. And Vietnam is just like one stop on the push too.
Is there a reason why investors should think that maybe these economic issues that Yellen is there, that she's there addressing, can sort of be separated from some of the military and other social issues that are also part of this broader disagreement between the U.S. and China?
I think what she's trying to signal is that, when it comes to national security, we are going to focus on that first, but we do seek to take targeted measures and not kind of like broad economic measures that would affect all sectors. So I think the message is it's targeted and it's national security related.
All right, Victoria Dendrino there, Bloomberg Treasury reporter. A look here at some of the comments that we got out of Janet Yellen a little bit earlier during that exclusive interview with Anne-Marie Horton. A look, of course, at the world's second largest economy, and a look at, one of the fastest growing economies in the world, over in Latin America. And unfortunately, that speed, that strength has now slowed. Peru, Brazil facing recessionary conditions. That conversation coming up after the break. This is Bloomberg.
There's much oil to be found in the lower 48 at this point, or even in, let's say, Alaska as well, or mostly we know where all the oil is, and there's no more big Permian Basin kind of deposits anywhere?
People have said that over time, and then we've always been surprised. And so the U.S. has been explored more than any other place in the world. I think the industry has a good idea, but technology allows you sometimes to recover things that you haven't been able to before. That's the story of shale. The other one that continues to be a positive story is deepwater Gulf of Mexico, where we'll go out and drill in a mile or more of water depth and then go down several more miles and find large fields. And the Gulf of Mexico is still relatively underexplored compared to the onshore. So I think there's still room for more discoveries.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
All right, Two of Latin America's biggest economies for a while have been defying expectations, but now they're doing it again. It's to the downside. Peru heading toward a technical recession at a time of global growth. Meanwhile, Brazil's economy shrank more than expected back in May. Joining us right now to talk a little bit more about this is the co-host of Bloomberg Daybreak Asia and our chief emerging markets correspondent, Sherry An. And let's start with Brazil here. I guess it wasn't totally unexpected that they're heading towards contraction, but it's still pretty significant.
Yeah, especially given that the central bank has held rates at that 13.75% for almost a year, right? So they were trying to curb inflationary pressures, also perhaps a lot of economic activity leading to price pressures. But now we're seeing that their economic activity index, which is a proxy for GDP, has fallen about 2% year on year, which from the previous month, actually, which is more than all forecasts by Bloomberg. And that puts the central bank also at a tough position where you're thinking, swap market is now thinking you'll have to cut rates even more than expected.
Well, that's my next question. I mean, anytime you have an economic downturn like that, the first thing people want are rate cuts.
Especially President Lula, that's been pressuring the central bank so much recently. We are seeing the central bank now being open for rate cuts starting next month, but nothing is for certain right now. What they advocated last time was for serenity and patience.
Serenity?
In serenity. I love that phrase. I was like, I saw serenity in our headlines. I was like, yeah, that's an interesting one to really urge markets and investors and the economists when watching the impact of high rates on the economy, that coming from the central bank. So the inflation target for the central bank right now, 3.25% for this year. They were able to tame those very harsh inflationary pressures that they've seen in the last few years, but still that has come at a price when it comes to economic growth.
Talk to us a little bit about Peru as well, because in addition to Brazil, of course, we're not seeing great news out of Peru's economy. What's the latest there?
I love that we're talking about Peru because we really don't talk about Peru that much, right? An economy that has been the fastest growing in Latin America for the past century or so. In fact, this is new information for me as well. They only had 1 month of contraction from 2008 to the pandemic in 2020. So now they're seeing in the past 5 months a contraction of 0.5%. And that leads us to think that they are facing technical recession. And perhaps not surprising given the political turmoil that they've had. They have a new president because the last one was ousted. In fact, they had 6 presidents in the past 7 years. So a lot of political risk to talk about in Latin America, including in Ecuador. I'm actually speaking to the president of Ecuador, Guillermo Lasso, later this week. And he's another president who had to dissolve Congress because of all of these political risks and oppositions in his country.
But even with, I mean, focusing back on Peru, what you were saying about political turmoil, we know that's been happening, but I feel like the economy has really been the bright spot. How surprising is it that now we're looking at a technical recession?
I think it also has to do with the fact that they're facing one of the biggest challenges that many developing economies are facing, right? Extreme weather is a big issue. We have the El Nino weather pattern as well that's warmed up the waters around Peru, and now apparently their fish meal industry has shrunk about 70% or so, and that is the largest in the world. So that's starting to hit them. Commodities prices going up, inflation pressures, and you have on top of that political pressures, and that is really having an impact on the Peruvian economy.
All right, Sherry An, you can catch her every day as co-host of Bloomberg Daybreak Asia, our chief emerging markets correspondent here. A look at emerging markets coming off a 5-day rally, relatively unchanged on the day. Meanwhile, back here in the U.S., stocks trying to get their mojo back here. A relatively tepid open at the start, Katie Greifeld, but now seeing some strength as we get closer to the closing bell. NASDAQ 100 up 0.9%.
0.9%, yeah. Big tech reestablishing itself, leading this market higher. You can see that's met with a rally in the bond market. 2-year Treasury yields down 3-4 basis points or so. Again, I mean, the front end of this yield curve has been so volatile, Romaine. Just really fun to watch.
Yeah, fun to watch, I guess, depending on what side of the trade you're on, Katie Greifeld. But we didn't talk about this idea of kind of different asset classes saying different things about the economy, different things about financial conditions. You take a look there at that 2-year yield. You take a look at what's going on right now in some of the individual names as well. AT&T, once again, one of the big individual decliners on the day. Stick with us. Romaine Bostic and Katie Greifeld counting you down to the close. This is Bloomberg.
Okay, so you're moving in on me. Quick. You're distracting me with your fancy hands. I'm going to deal with your knight because it's really bothering me.
Ah, my knights.
Yeah, he's a troublemaker.
Yeah.
What did you get up to this weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Ooh, I don't like that. I will take this. Put it over here.
Not cool. Not cool. All right, I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir. Thank you.
Moment news breaks. No one covers the world like Bloomberg.
The word here continues to be, let's stand with Ukraine, quote, support Ukraine so they can win militarily and obtain their objectives on the battlefield.
For Taiwanese stocks in the first half, 30% up from the lows that we saw last year. It's really been driven by this whole AI, semi sort of trade here.
The $69 billion deal was the biggest video games deal, but it's also pretty much the biggest technology M&A. Makes it pretty exciting here.
Bloomberg, your global business authority.
From New York City.
From London. In Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
This is Bloomberg Markets, the close, almost 2:30 here in New York. Green on the screen in U.S. equity markets. A lot of red on the screen when it comes to commodities. Abigail Doolittle standing by right now with our commodities close.
There is a lot of weakness for commodities today, Romaine. Overall, the Bloomberg Commodity Index right now down about 0.9%. Its worst week in almost 3 weeks. This is the dollar is basically flat to down to up, fluctuating a little bit. I think a lot of it has to do with China. Of course, those disappointing GDP numbers, and also some are saying that Beijing may not offer as much stimulus as hoped. So we do have the commodity complex overall weak because China, of course, is the world's largest user of natural resources. Crude oil down 1.7%, copper down 2.2%. Also on crude oil, we do have some Libyan production reemerging, so that untightened supply, if you will. And then both wheat and corn are down. We were talking about it last week. We didn't know whether or not Russia would stay in the Black Sea deal. Well, as you know, they've pulled out. So now that is bringing down, it seems to be pressuring in weird ways. You would almost think in some ways that it would help out these grains, but that's not the case right now.
Yeah, a lot of big stories right now moving in the commodity space. Abigail Doolittle there with a check here on our commodities closed. Meanwhile, let's pivot back to some of the individual movers in the U.S. equity space. United Airlines shares fractionally higher. This after reaching a deal in principle that is the richest ever at a U.S. carrier. A labor deal, we should point out, that keeps the pilots working amid, of course, what has been a summer of labor strife. Simone Foxman joining us right now to talk a little bit more about this. And Simone, I mean, we've been talking so much about strikes in Hollywood, potential strikes in auto workers, potential strikes for UPS drivers. At least for United, it doesn't look like we're going to have any issues with the pilots.
Yeah, that's right. The union saying this is a $10 billion deal, as you mentioned, the richest ever for a U.S. carrier. And it contemplates pay rises of 35 to 40% for these pilots. So those are substantial, also substantial some scheduling changes that will allow them to have a little bit more control of their schedules, retirement, all that soft stuff as well. So keeping those pilots in the air, it was 4 years of negotiating. They finally kind of came to a decision.
Yeah.
4 years of negotiations. Now we have this deal in principle. What are the expectations that this will actually get ratified?
I think they're very high. There are a couple weeks between now and when we could see members of this union go and vote on them. The actual text of the agreement, the details have been hashed out, but the actual text has to sort of be finalized. And then, of course, it has to be reviewed by the Executive Council and ultimately go to a vote. But I think the thinking here is this is a pretty good deal. And in fact, you had American Airlines, which is in the midst of signing its own agreement, Delta, watching this deal closely. In fact, American Airlines is going to meet with members of the union to see if they need to make any changes to a deal that members, were positive on 4 months ago.
So let's get down to the brass tacks here for some of these airlines. I mean, it's good they got the pilots on board. We know there's there's been a lot of other issues with these airlines. Making a lot of money, they have a lot of passengers, not necessarily all the people and infrastructure to support that. We got Delta Airlines, what was it, last week? They were pretty bullish.
Yeah.
We're supposed to get American and United. What are we expecting to hear?
Yeah, well, one concern I should say before we launch into this earnings is that there are a declining number of pilots likely with retirements of older pilots. So all these airlines are going to face a need to get more pilots in this cockpit, and that's going to take some investment.
Well, that's probably why they're paying so much. I mean, this has been a structural issue for a long time, and I presume that's why the 30, 40, whatever you said, 40% they got.
Yeah, and Bloomberg Intelligence estimates that we're not going to actually see a peak to the retirement of these pilots until 2026. So we could have worse to come. But I mean, looking forward, costs going to be an important thing for both American as well as United. We have seen some disruptions. However, the demand has really been there, not necessarily for the domestic consumer, but for the international one that hasn't been to Europe for 4 or 5 years and says now's the time, post-pandemic, we want to go.
Well, let's couch this conversation on what we're seeing in the broader economy, because it's not just the pilots, of course, top of mind. We know that the Hollywood actors and writers are on strikes, and then in other industries too, you're having these labor disputes carry on. What we're seeing with the airlines, how does that compare with other negotiations that are ongoing right now?
I think how specific, how complicated these skills are is the difference perhaps between the UPS negotiations, the one with the actors, as well as more broadly in Hollywood. You know, this takes a lot of training. These are, you know, professionals who have to spend a lot of time in the air before they can become commercial pilots, and that makes their skills quite rarefied, and that's why you're seeing that pay boost. I mean, UPS, you know, truck drivers are very important. This takes a certain degree of skills. Same with actors and actresses and other members of Hollywood, but this one, you know, might mean more investment in order to replace that kind of workforce, and therefore you see the airlines kind of bending.
All right, Simone Foxman there with a look at United Airlines here. Shares fractionally higher on the day. A couple of points of breaking news crossing the wire as she spoke. We're going to start off with FedEx, learning that they have settled on a new CFO, excuse me, a new Chief Financial Officer, and that is John Dietrich. He is the former Atlas Air CEO. He will be joining FedEx as their new CFO. Remember, we knew that Michael Lentz, the CFO over at FedEx, had planned to retire. It was just a matter of finding out who would replace him. And then we want to turn to the housing market here. One of the main figures in the global housing collapse back in 2008, Angelo Mozilo, we've learned, has passed away. He was 84 years old. We're told by his family that he died of natural causes yesterday, July 16th. Of course, he was the CEO of Countrywide Financial and really propelled that company to one of the juggernauts back when lending standards were a little bit light. And of course, the subprime lending boom really elevated a lot of these companies to kingpin status. Of course, he was forced out of that position amid some of the concerns here about the quality of those loans and the reverberations across the economy. Angelo Mozilo, who had a long career even before getting to Countrywide, died at 84.
Three prime ministers, 4 chancellors, an energy crisis, and the soaring cost of living. It's been a hard year for startups, but even in the toughest times, some of the best ideas are born here in the UK. Bloomberg UK's Startups to Watch will profile the brightest companies under 10 years old, with the winners unveiled at the Bloomberg Technology Summit in London in October. Get your entry in by the 7th of August for the chance to have your company profiled and to attend unique networking events. Good luck, and we hope to see you there.
One of the ones we're working on at the moment is how do we charge back into Ukraine as soon as the European authorities say it's safe to fly in Ukraine again. Now, nobody knows when that is going to be. But we were Ukraine's second largest airline when the Russians invaded on the 24th of February last year. We would be Ukraine's biggest airline the week after they tell us it's safe to go back in there, because we're going to charge back in there. Initially, we have a plan to open up about 30 routes from 4 Ukrainian airports back into the European Union. And then we want to, I think, within 6 to 12 months, open up 3 or 4 large bases in Ukraine. And we're talking to the Ukrainian authorities about creating an environment, cost agreement, on which we could lead the charge of air travel into a post-war Ukrainian recovery.
The names that move markets are on Bloomberg.
China has seen slower growth than they expected. Many countries do depend on strong Chinese growth to promote growth in their own economies. For the United States, growth is slowed, but our labor market continues to be quite strong. I don't expect a recession. I think we're in a good path.
Nobody covers business like Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start with Yelp. Goldman Sachs flipping to a buy rating from neutral and boosting the price target street high, $47 a share. The analyst citing an improved digital ad environment and says Yelp could generate mid to high single-digit revenue growth going through 2027. Shares having a great day, up almost 10%. Next up, let's take a look at Yeti going in the opposite direction. KeyBank cooling on the stock with a downgrade to underweight and a street low price target of $34. Concerned that macro headwinds may crimp consumer spending, and the analyst saying it's got a lot less conviction out there right now in the face of recent price cuts, heavy inventory, and increased competition. Yeti Holdings down by more than 6% on the day. And finally, let's end on NVIDIA. Citi actually boosting its price target to $520 from $420, with the analysts actually seeing a pathway to $600 a share in a more bullish scenario. Now, the stock has already more than tripled this year. The analysts adding that it's clear the market for AI is bound to grow at a blistering pace, and the chip maker is well positioned to defend its market dominance. Shares higher by about 1% on the day, and those are some of our top calls. We do want to stay in the sell side space and, well, stay, I guess, in the crypto space. Last week's ruling that the Ripple token is a security when sold to institutional investors, but not the general public, could have a big impact on the crypto space. Of course, Coinbase rallied more than 20% on Thursday, still holding that $100 level today. Jason Todaro, senior research analyst over at Needman and Company, joining us right now to talk a little bit more about this. And I know, John, we're still a long ways away from the peak levels that we saw a couple years ago with Coinbase, but what is the path forward here when we talk about the stock?
Yeah, sure. So first off, you reduced some of that regulatory concern, that overhang that was on the story, and that was a key part of it. There was a lot of institutional investor concern around Coinbase due to the regulatory constraints that looked like they were on the name. With the Ripple case, you have a little bit clearer of a path forward now, or where you can see the stock can start working. So first off, you've removed some of that regulatory concern. There's obviously some still out there, but this was kind of the first step in that process. And now what you need is retail volumes to start coming back. So Q2 actually should still be a pretty bad quarter for Coinbase. It should actually be one of their lowest volume quarters since as a public company. But after Q2, you have the Bitcoin halving coming up in the first quarter of 24. You have these Bitcoin ETF applications that have come through from BlackRock and other major financial institutions. So you can see a path where institutional and retail volumes can start coming back into crypto. You're getting a little bit more of that regulatory clarity, which can also allow that. And that's what really needs to happen for Coinbase to get moving.
Well, let's talk specifically about the shares, though, because as you mentioned, we are heading into that earnings risk. Maybe volumes will pick up towards the latter half of the year, but for the second quarter, expected to be pretty ugly. Coinbase shares up nearly 200% year to date, and a lot of that coming just in the past month or so. And even though I know you just boosted your price target, is there a risk here on the path to that 12-month target that we get a pretty significant pullback in Coinbase stock?
After the rally, you can see a little bit of the stock cooling off some, but I would say a lot of the risk around Q2, some of that should be priced in. So volume numbers, those come out at the end of June. Everyone had a pretty good look at them throughout June. The quarter was pretty rough throughout, so it wasn't like 1 month really brought it down and tanked it. So a lot of institutional investors should have a pretty good handle on where that quarter is going to be. As you mentioned, expectations are pretty low. So some of that should already be baked into the stock. If they materially underperform, sure, then the stock can come down some more. But it doesn't look like that would be the case. I think everyone's got a pretty good handle on volumes being pretty low. And now everyone's looking at, well, what's next? Can the ETF applications get volumes starting to go? Is this Bitcoin halving coming up? Is that going to juice Bitcoin prices a little bit more, volumes a bit more? Can this market start coming back? And you're seeing that some. So July's on track to be a better month than June. So you could make the case that June maybe is the bottom for retail volumes, and now we're starting to get more constructive.
Let's talk a little bit more about those spot Bitcoin ETF applications, because that obviously has breathed a lot of life back into the space. It's interesting, if you look at the BlackRock application, Coinbase is listed as the custodian. And then you think of its existing products, such as the Grayscale, Bitcoin Trust, Coinbase, the custodian there too. Even if trading volumes continue to be muted, how big could the custody business be for Coinbase?
Coinbase is still mostly going to be an exchange retail business. So the custody business would have to become very big for that to offset lowered volume. So for Coinbase to work, you are going to need those retail volumes in particular, not even just institutional volumes. You do need retail volumes to come back in this space in quite a big way for the stock to materially work. Custody business can support it. Some of the subscription and services businesses can support it. But still, at the end of the day, if you want to get back to all-time high levels for Coinbase, you are going to need retail volumes to come back unless some business line materially changes.
All right, John, great stuff. Great to catch up with you. John Todaro over at Needham & Company here. A look right now at Coinbase here. Down for a second day, but of course that's coming off that big 20+% rally that we saw on Thursday. Just staying in the crypto space and more importantly on the chip space, some breaking news crossing the wire. Bloomberg reporters learning now that the chief executive officers of some of the biggest semiconductor companies out there are set to meet with White House officials, including National Economic Council Director Lael Brainard and National Security Advisor Jake Sullivan. This, of course, about some of the curbs that the Biden administration has been seeking to put on the transfer of some of that chip technology. We'll dive a little bit deeper into that later once we get some more details. Meanwhile, after the break, a conversation coming up with Douglas Holtz-Eakin of the American Action Forum to discuss the role the government plays when it comes to imposing ESG restrictions. This is Bloomberg.
What do you like most about your job?
I think the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. What's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to Bloomberg Markets to Close. Time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. And David, there's been so much talk about ESG. It's obviously boomed into its own cottage industry, but there's been a lot of backlash to it, both on Wall Street and, of course, in Washington as well.
As well as in state houses. You're exactly right. Washington's a hot topic conversation there, but a lot of state houses now are saying we want to really constrict the extent to which state funds can be invested in ESG funds. Take us through exactly what this means, particularly for the returns for all these funds. Welcome now Douglas Holtz-Eakin. He's American Action Forum president and former head of the CBO. Doug, thanks so much for being here. You wrote a piece on this very subject. And I guess let me start with the question of, if you just want to make money off your investment, are you better off with ESG or without it, or should somebody else be deciding?
Well, I certainly think investors should be deciding whether this is, material information about the financial future of the investments they want to make. And you can imagine situations where it might very well be material for a very long-lived, clean energy investment, something like that. Sure, environmental information might be valuable, but it should be decided on that basis, and we should be providing investors with the information they need to make their decisions. That's always been the most effective way to run a capital market and other markets.
So I'm a little perplexed about this. On the one hand, I thought that these funds really had some certain fiduciary duties, and if they're complying with fiduciary duties, and they're doing their job. On the other hand, I do understand that a given state, take Florida, take Texas, could say, look, for our money, we don't want to invest it that way. Is there anything wrong with that?
So the reason I wrote the piece is I was trying to sort through all these issues. So if you look at it from the perspective of a state, those elected officials are there to do the wishes of their voters. And if they don't want to touch ESG in their investment portfolios, there's nothing wrong with that, right? They can be respectful of that. They might want to be mindful of the fact that they're passing up additional potential bidders on contracts, and so they might be paying more for services than they would otherwise. It might not be free, but they're certainly, able to do that. As for the firms themselves, if it's your money you're investing, you get to decide. If it's someone else's money that you're investing, well, you have a fiduciary responsibility to get the highest rate of return. And so if you see me as a money manager investing in some ESG stocks, I think that probably must mean I think those have the best financial future, because that's my job. And be clear about the roles people are playing. That's the most important thing.
Well, I'm curious, Doug, just about kind of this idea of setting sort of these guardrails, if you will, in terms of making these decisions for what these funds can or cannot invest in. I understand broad strokes, saying, okay, we want to sort of be in this area and not in that area because of some sort of additional risk that might be put on to these funds. But when you get into sort of the granularity of some of these ESG issues, what is the benefit?
I'm confused by this. I'll be honest. I understand, providing standardized information. So if there's something out there on the environmental front that you can provide that gives you the ability to compare across companies or across sectors in an effective way, that's valuable information. You can provide that. But dictating what can be the composition of the portfolio, to me, is a step over the line. It used to be the case that conservatives especially were mindful that they might not agree with other private sector participants, but it's the private sector, and they get to make up their mind about what they want. What we see now is an increasingly interventionist right-wing conservative bloc that wants to use the power of the state to tell people what they can do. That just doesn't feel good.
When do you see that sort of arresting itself at some point? Because it does seem to go against the ethos of what we've seen from the right and the Republican Party for decades now. And I know that there are sort of forces now that have taken over this party that maybe don't dovetail with history, but I do wonder if that runs its course.
Well, one would expect it to run its course on financial grounds, because the private sector is better positioned to make smart investments. And if it turns out, all these things that the governors told us we could do and the federal government told us we couldn't do didn't get us a decent retirement, then that's really a route to let's get them out of this business. But also, I think it's just the that part of the bloc, part of the conservative movement's reasserting itself. The notion that this country is uniquely dedicated to freedoms, and that includes economic freedoms. We ought to keep the government out of those decisions.
Doug, is it a fair question to ask who is the investor for this purpose? Because there's been a lot of focus, for example, on Larry Fink at BlackRock saying, well, that's what you like, Larry, but what about the people who invest in these ETFs? You saw BlackRock now is proposing the possibility of people who invest in the ETFs, they get to vote, actually, on some of the shareholder initiatives. Does that make sense so that I, as a direct investor, get to decide whether I like ESG investing or not?
I think that if I want to forego some return because I have an environmental goal, right, and that's my money, it's my investment, and I can, if well-informed, make that decision. And if BlackRock wants my business, they better provide me with that opportunity, right? A fund that doesn't and one that does not touch ESG investments is a perfect business strategy. BlackRock shouldn't make the decision for me, though. It should be the investor. That's the key.
Doug, let me come back to my first question. Do we have any sense yet, or is it too early to know what people may be leaving on the table either way, by taking into account ESG or not taking into account? There have been some estimates you've seen that maybe $700 million, I saw one estimate came out, that the states may forego by really restricting ESG. Do we have any sense of really what it's going to cost?
We don't have a great sense. I think that's an illuminating figure. You restrict competition for a state contract, you end up getting less of a good deal, and that's where that $700 million comes from. You know, we have seen the state of Florida take its contract away from BlackRock. What do they get with the alternative? We don't know, but I think you serve the taxpayers' financial interests best by having vigorous competition for bids on state services. That's always been the route, and this restricts that to some extent, and it will cost you something.
Do voters understand, and by voters I mean the actual people who are the beneficiaries of these pension plans, do they understand the difference in returns, or I guess the potential, I should say, difference in returns? So if they get a less of a return, are they going to make that connection, Doug, to some of the political decisions that were made, or is it just all a wash?
I don't think it's going to be obvious to them what went on, but I think this is why we've drafted these positions with fiduciary responsibilities, so that they are not allowed to have their personal tastes, their personal political desires, their personal social goals interfere with their investing job, and that insulates the taxpayer from that kind of an influence, and that means they don't have to know. Right? You just give them a single objective.
Okay, Doug, thank you so much for being back with us. That's Douglas Holtz-Eakin, American Action Forum president. So there's a lot left to be decided on ESG, without a doubt.
Yeah, and I mean, look, we know this is a political football, but it does get to the idea. At the end of the day, this is about your return on investment, and if that suffers because of these decisions, at some point, someone's going to pay.
Well, exactly. You'd like to believe that sooner or later the system will correct itself.
Yeah.
If people are losing too much money, they'll change their mind.
I mean, we talk about politics so much, and we know there's a certain sport there, but when it starts to affect your actual money, then that becomes a totally different
Exactly. It's talking about actual money. You know we have coming up tomorrow, retail sales.
Oh, okay.
So we're going to have Mickey Drexler. He is retailer par excellence. Alex Mill, chairman, and former J. Crew and Gap CEO. When we talk about retail, we love to talk to Mickey. And then on Friday, we're going to get together Steve Ratner from Willett Advisors and Larry Summers, former U.S. Treasury Secretary. We're going to talk to them about AI and whether it really could help us on productivity. That's coming up at 6 p.m. Eastern Time on Friday.
All right, be sure to check that out. And you can catch David Weston every day around this time for our Wall Street Week Daily segment as we get ready to set you up for the final hour of trading here. A modest rally in equity markets, a relatively tepid price action in other areas of this market, including in treasuries, including in the dollar. Though we should say there is a big downdraft going on right now.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec.